me to go, and I'll know when somebody calls on me?
Yeah, so
That's
the
right.
chair will. The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Rent a Bank and New Debt Traps, Assessing Efforts to Evade State Consumer Protections and Interest Rate Caps. And I will now recognize myself for 4 minutes to give an opening statement. In November of last year, the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency issued a proposed rule that would provide legal cover for predatory rent-a-bank schemes, where payday lenders partner with banks to peddle harmful short-term triple-digit interest rate loans in states that have reasonable and often voter-approved interest rate caps to protect consumers. Even if a state like my home state of California has passed a law setting a usury rate cap, this rule would allow lenders to ignore the law and to import high-risk, and otherwise illegal loans back into the state. Low-income consumers who are already struggling will pay the price. American consumers used to be able to look to their regulators to protect them from these kinds of predatory schemes. Not so under the Trump administration, where consumer protection takes a back seat to consumer predation. And Trump's regulators are working overtime to make sure that bad actors have a clear path to trap millions of Americans in an unending cycle of debt. This anti-consumer rule is just the latest to benefit predatory payday lenders. When Trump's acting chief of staff, Mick Mulvaney, was running the Consumer Financial Protection Bureau, or the CFPB, he did everything he could for predatory payday lenders, including withdrawing a lawsuit against a group of deceptive payday lenders who were allegedly ripping off consumers with loans with interest rates as high as 950% a year. It is little wonder that a CEO of a notorious payday lender thought nothing of submitting her resume to be considered as the next CFPB director, but the job instead went to Kathy Kraninger, who is no doubt making that CEO proud. Director Kraninger has both delayed and proposed to undermine key provisions of the CFPB's important payday, small dollar, and car title rule, which would have curbed abusive payday loans. And 101 other House Democrats wrote to Kraninger to call on her to reconsider her effort, but she has not relented. Today, we will examine the implications of regulators' actions to open the payday loan floodgates and the impact this will have on states with sensible interest rate caps. We will also discuss H.R. 5050, the Veterans and Consumers Fair Credit Act, Congressman Garcia's bipartisan bill to place a federal 36% annual percentage rate usury cap on payday loans and car title loans and extend the protections that active duty service members have under the Military Lending Act to all consumers across the country. It is long overdue for Congress to take action to ensure that all Americans are protected from harmful payday products with sky-high interest rates. So I look forward to hearing from our witness panel of advocates and experts. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, Madam Chair, thank you for holding this hearing. I think it's important that Congress, I think it's important and essential that Congress understand how the banking industry is evolving in response to technological innovation. It also is essential to help Congress understand its role to ensure all consumers benefit from advances in technology. So I think it's a meaningful conversation that we can have today. Technological innovation over the past few decades has enabled faster, more accurate credit underwriting for a much broader population of borrowers. Much of this innovation has been driven by industry newcomers that have developed a new idea or business model faster in time than it takes to get a bank charter. So these newcomers often partner with banks. Bank-non-bank partnerships can make sense for several reasons. First, economic. Because of their deposit-based funding, banks tend to have the cheapest possible cost of capital among all capital allocators. Second, capacity. Banks have relatively large balance sheets, enabling them to absorb new loans rapidly. Third, expertise, and expertise still matters. Banks are expert lenders. In other words, they are proficient in such tasks as underwriting, compliance, and securitizing or selling loans into the secondary market. One other major reason fintech partners with banks is the special legal status banks have had for well over a century, actually a century and a half. Since the passage of the National Bank Act, Congress has given special privileges to banks, and that includes regulatory certainty about what interest rate banks are permitted to charge on a loan. When conducted properly, the benefits from this arrangement can be cost savings for fintechs and banks, better competition among banks, and better, faster, and cheaper banking products for all consumers. The best way to make sure that these partnerships live up to their promise is to provide a clear regulatory framework under which they can operate. To that end, I want to commend the recent efforts of the OCC and the FDIC for their proposed rulemaking that helps restore clarity to a segment of the market. Their proposed rules would clarify what we all thought we knew before 2015, that when a bank sells, assigns, or otherwise transfers a loan that was valid when it was made, that loan does not become invalid because of the transfer. This is a common sense rule of contracting that has existed for over 100 years, until 2015, when the Second Circuit Court's Madden decision decided that no, banks cannot be sure that their loans hold any value when sold. The Madden decision has been roundly criticized on its legal reasoning, but more importantly, economists have now measured the negative impact to consumers in the 3 states governed by this bad Madden decision. The uncertainty caused by the result has driven lenders away from those states. Borrowers with FICO scores below 625 have seen a 52% reduction in credit availability. Furthermore, personal bankruptcy filings rose by 8% more in those states relative to states outside the Second Circuit. We can clearly see the harm that results when lenders are faced with regulatory uncertainty. I'm pleased that we're hearing from experts today about the need for clear rules of the road. Technology is the key for greater financial inclusion, and while we must provide oversight and certainty, we cannot fear innovation because we don't understand it. Yield back.
I now recognize the chair of the Subcommittee on Consumer Protection and Financial Institutions, Mr. Meeks, for 1 minute.
Thank you, Chairwoman Waters. Despite a decade of economic growth, over 40% of American families don't have savings for a $400 emergency. This problem is compounded by the dramatic rate at which bank branches are closing nationwide and the rapid disappearance of small community banks and minority banks, which serve marginalized communities at a far greater rate than mega banks, creating banking deserts and depriving these communities of access to credit and financial services. As a result, check cashing stores, pawnbrokers, auto title lenders, and payday lenders often fill the gap. Payday lenders are especially harmful, trapping borrowers in unsustainable debt traps. We need to regulate payday lenders and address the terrible harm they cause across the country. But in doing so, we must ensure that something viable fills the gap. This committee has long advocated for bringing more people into regulated banking space, ensuring that consumer protection, anti-discrimination, and fair banking practice laws are all applicable and enforceable. This is a very real and urgent priority for me, and I thank the witnesses and look forward to their testimony.
I now recognize the subcommittee's ranking member, Mr. Lukemeyer, for 1 minute.
Thank you, Madam Chair. Thanks in large part to Dodd-Frank, financial institutions have largely exited the small dollar lending space. However, some financial institutions have managed to continue providing these products through partnerships with fintech firms that help with underwriting, marketing, and IT. Now it seems my colleagues on the other side of the aisle are going after these partnerships to push banks out of small dollar lending altogether. If that wasn't enough, the majority is considering legislation to enact an APR rate cap on all loans. Using APR, in my opinion, is a misleading measurement of any loan under a year in length and only serves to hide the true cost of a small dollar loan from consumers. Where is the transparency in that? On one hand, my colleagues are attempting to eliminate bank involvement in small dollar lending, pushing consumers into less regulated spaces, and on the other hand, they want to eliminate the ability for non-bank entities to offer small dollar loans. If they succeed, you have to ask the question, where will the unbanked and underbanked go to access credit? I don't think any of us will appreciate and will like the answer to that question. With that, Madam Chair, I yield back.
I'd like to introduce our witnesses and welcome you to the Capitol, to this committee. First, I see Ms. Graciela Aponte-Diaz, who is the Director of Federal Campaigns for the Center for Responsible Lending. Ms. Lauren Saunders, who is Associate Director at the National Consumer Law Center. Professor Creola Johnson, who is the President's Club Professor of Law at the Moritz College of Law at the Ohio State University. Assemblymember Monique Limón from the California State Assembly, who is serving as chair of the Banking and Finance Committee, and Brian Knight, Director and Senior Research Fellow, Program on Innovation and Governance at the Mercatus Center at George Mason University. Without objection, all of the witnesses' written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony, and when you have 1 minute remaining, a yellow light will appear. And at that time, I would ask you to wrap up your testimony so we can be respectful of both the witnesses and the committee members' time. Ms. Diaz, you're now recognized for 5 minutes to present your oral testimony.
Good morning, Chairwoman Waters, Ranking Member McHenry, and members of the committee. My name is Graciela Aponte-Diaz, and I'm the Director of Federal Campaigns for the Center for Responsible Lending. CRL is a nonprofit research and advocacy organization dedicated to protecting homeownership and family wealth by fighting predatory lending practices. For nearly 20 years, I've dedicated my career to fighting for low-income families and communities of color. I myself grew up low income with a single mom trying to make ends meet. Luckily, she was never a target of abusive payday or high-cost installment loans because she lives in Maryland, a state that bans these products. In fact, 16 states plus the District of Columbia do not allow payday loans, and the vast majority of states have interest rate caps on installment loans. Active duty service members are also protected from predatory loans through the Bipartisan Military Lending Act. Unfortunately, some lenders have found a way to continue to target vulnerable consumers despite state laws through rent-a-bank schemes. Here's how a rent-a-bank scheme works. A predatory non-bank lender decides that they want to lend at higher rates than what is allowed by state law. Frequently, loans of 100% APR or more, even in states that have a 36% interest rate cap or less. They find a bank that is willing to originate the loans because national and federally insured banks are exempted from state interest rate laws. After the loan is processed, the bank sells the loan or receivables back to the non-bank. The non-bank handles marketing, consumer interactions, and servicing. The non-bank lender is the public face of the loan, and neither the customers nor the general public are aware of the motions behind the scenes to legitimize a loan that would otherwise be illegal. Non-bank lenders such as Elevate, OpLoans, Inova, LoanMart, and World Business Leaders currently lend at outrageous rates in states where those rates are illegal under state law, through the use of rent-a-bank schemes with banks regulated by the FDIC and OCC. Neither regulator appears to have done anything to shut down these abuses. I'd like to share 3 examples of high-cost loan documents that I've seen firsthand and borrowers that I've worked with. A disabled Marine veteran was targeted with a $5,000 loan at an APR of 115% and a ridiculously long term of 84 months. As stated in her loan documents, that resulted in $42,000 to borrow just $5,000 over 7 years. Not surprisingly, she was unable to keep up with these unaffordable payments and ended up in bankruptcy. In another example, a single mother was targeted for a $2,500 loan with an APR of more than 100%. After 5 years, she paid back $14,000 but was unable to save for her daughter's college tuition. And finally, a Spanish-speaking man was lured into a store that said "Se habla español," which means we speak Spanish. However, no one spoke Spanish and all the loan documents were in English. He walked out with a $2,700 loan at 123% APR. Worse, it was secured by the title of his truck. He had to pay back $10,000 over a 5-year term or risk his only mode of transportation to work. These are just some examples of a now too common loan that is being offered online or through storefronts that are disproportionately located in communities of color. This is not access to credit. This is not access to innovation. This is access to debt. Fortunately, there are ways to stop these abusive lending practices. First, we need the FDIC and OCC to take enforcement actions against these predatory lenders that are using rent-to-bank schemes and offering illegal loans in states with rate caps. Second, the FDIC and OCC should rescind their proposal that does nothing to address this abuse and, in fact, emboldens predatory lenders to engage in rent-to-bank schemes. Third, Congress should swiftly pass H.R. 5050, a 36% interest rate cap bill for veterans and all consumers. And finally, the FDIC should preserve its 2005 payday loan guidelines, its 2007 guidelines advising of a rate cap of 36%, and its 2013 guidelines advising of ability to repay for all bank payday loans. Let me thank the committee again for the opportunity to address these scams and real-life situations. I look forward to your questions.
Thank you for your testimony. I'm not going to just go back into order. I just realized I jumped out of order. So I'm going to now recognize Assemblymember Limón for 5 minutes.
Thank you. Thank you for holding this hearing and inviting me to testify on how rent-a-bank schemes undermine state consumer protection efforts. My name is Monique Limón. I serve as the California State Legislature as the Assembly Member and Chair of the Committee of Banking and Finance. High-cost consumer loans have created havoc for California families over the last decade. Driven by the desire to avoid the forthcoming CFPB rule, the payday lending industry began to aggressively market larger, longer-term loans to vulnerable consumers who were trying to pick up the pieces caused by the Great Recession. The average size of these loans is about $3,000 with an annual interest rate of 100 to more than 200%. While these high interest rates are unconscionable, I am more concerned by how often consumers default on these loans. As we dug through the data, we found that more than 1/3 of borrowers could not repay their loans, representing more than 100,000 Californians each year. Failing to repay a loan exposes consumers to serious negative consequences like aggressive debt collection, ruined credit scores, vehicle repossessions, and even bankruptcy. While consumers try to find a way out of this turmoil, high-cost lenders are able to stay profitable because of their extremely high rates and fees that they charge. Over the past several years, the California legislature attempted to address this problem by establishing a ceiling on interest rates, similar to policies adopted by dozens of red and blue states across this country. It took us 3 years and 5 different bills before we found the right balance to keep responsible lenders in the market while also protecting consumers from high fees and defaults. Last year, I introduced a bill that caps rates on loans in the $2,500 to $10,000 range at 36% plus the federal funds rate. This bill received strong bipartisan support from a broad coalition of lenders, consumer groups, faith leaders, veteran organizations, and community groups across the state. On the strength of this coalition, the bill passed with broad support and was signed by law by our governor. In summary, the effort was thoughtful and deliberate. The legislature considered multiple options until we found the right balance. But now that the new law is in place, high-cost lenders are looking to exploit gaps and ambiguities in the administration of federal banking laws that would allow these lenders to evade state laws and continue with business as usual. When left unchecked, these rent-a-bank schemes perpetuate the system of misaligned incentives that allows lenders to profit even when many of their customers fall into default. Both the FDIC and OCC have stated that they do not support bank partnerships designed to evade state laws. But those agencies need to back up their words with actions. Until they act, there will continue to be a small number of banks and lenders who try to dodge state laws. Before I conclude, I want to be clear that I do not believe that all bank partnerships are bad. Bank partnerships that create products where the interest of borrowers and lenders are aligned can be a healthy part of the financial system. However, at the very least, bank partnerships must be limited to banks that follow the FDIC's 2007 guidance on offering affordable, small-dollar loans, which encourage banks to offer small-dollar credit with APRs that do not exceed 36%. The federal government has the ability to fix the problem of the rent-a-bank schemes with solutions that protect state sovereignty, protect consumers, and create fair and competitive credit market with all lenders playing by the same rules. Thank you for bringing attention to this issue. I am hopeful that Congress can work with the FDIC to ensure that a handful of supervised banks are not being used to undermine state consumer protection laws across this country.
Thank you. She yields back. Thank you for your testimony. I now recognize Professor Johnson for 5 minutes.
Good morning. I am Professor Creola Johnson at The Ohio State University College of Law. I was the first academic to write a law review article about payday lending. It was based on my research, which was funded by the university, where we actually took out payday loans. And what I discovered through this research of payday lenders surveyed in Franklin County, Ohio, is that they had two primary goals. First, to get the consumer to sign up for a loan without understanding the consequences of what they were signing up for, and to get the consumer on the hook to pay as long as possible at triple-digit interest rates. As has been mentioned, the rent-a-bank schemes are part of keeping consumers in the dark. The consumer goes to a physical store, interacts with a lender that is a non-bank entity, has no interactions at all with the bank that's in the background. As I put in my remarks, this is part of the overall mission of keeping people in the dark, keeping the consumer in the dark. As a result of my research, I concluded that rent-a-bank schemes allow non-bank lenders to get away with charging triple-digit, quadruple-digit interest rates. And not only so, but to keep consumers on the hook. And I describe these practices in three main areas. I call them debt entrapment practices. And by that, I mean practices that seek to get consumers on the hook. And by that, I mean they're approved for credit in a minimal amount of time. Someone mentioned a few minutes ago that we're able to do this quickly. You're able to do it quickly because you're not actually focusing on the ability of the consumer to pay back the loan. Debt entrapment practices also include issuing large amounts at triple-digit interest rates, short maturity dates. In other words, paying back the loan in a short period of time where the majority of customers cannot pay back that debt and keep up with their ongoing expenses. The second category of illegal practices are what I call Treadmill Practices. These practices are designed to keep a continuing stream of payments coming in from the borrower. They include multiple rollovers, extending the loan date multiple times, back-to-back loan transactions, rapacious electronic debits to the consumer's bank accounts, and illegal garnishment of consumers' wages. Third, criminalization practices. These practices include making the consumer feel that they need to fear imminent arrest unless they comply with the non-bank lender's demands. These include threatening to prosecute consumers for crimes, filing police reports against them for criminal charges, misusing civil contempt proceedings to obtain arrest warrants against consumers. These three practices, debt entrapment, debt treadmill, and debt criminalization practices, are what non-bank lenders want to do. And they want to be able to hide behind the banks to perpetrate these practices. Let's keep in mind that these non-banks are not subject to regulatory oversight by the FDIC or the OCC. So they should not be able to get away with these practices by hiding behind the preemption doctrine. This is important for us to focus on not just new technology, but focus on protecting the state sovereignty, to protect consumers from usurious interest rates and these practices that I just spoke about, and to protect consumers based on all of these consumer protection laws in all 50 states and U.S. territories. And yes, we want to balance that with allowing for reasonably priced credit products for consumers, but they have to be balanced against the state sovereignty and state consumer protection laws. Thank you for allowing me to speak, and I look forward to your questions.
Thank you for your testimony. Ms. Saunders, you're now recognized for 5 minutes.
Thank you. Chairwoman Waters, Chairman Meeks, Ranking Member McHenry, and members of the committee. Thank you for inviting me to testify today on behalf of the low-income clients of the National Consumer Law Center. Today, we are facing the biggest threat in decades to states' historic power to protect Americans from predatory lending, rent-a-bank lending. Interest rate limits are the simplest and most effective protection against predatory lending, strongly supported by American voters of all stripes. At the time of the American Revolution, every state had interest rate caps, and the vast majority still do today. For example, on a $500 6-month loan, 45 states and the District of Columbia limit the rate at a median of 37.5%. At the end of the 20th century, however, most banks were exempted from state rate caps, and rent-a-bank lending began as the latest in a long line of attempts to evade state usury laws. Short-term payday lenders first tried using rent-a-bank schemes 20 years ago, but the bank regulators shut them down. Yet in today's environment, high-cost lenders across the country are again using a small number of rogue banks to offer loans at astonishing rates that they cannot offer directly and that banks would not offer in their own branches. My fellow witnesses have described some of the loans being offered to consumers. I'd like to focus on the rent-a-bank lender that the OCC and the FDIC are actively supporting, World Business Lenders. The FDIC and the OCC filed an amicus brief supporting World Business Lenders and its right to charge a Colorado business 120% on a $550,000 loan because the loan was originated by the Bank of Lake Mills and then assigned back to World Business Lenders, the same bank, by the way, that the FDIC had sanctioned for targeting our service members. We have discovered several cases involving similar facts. World Business Lenders or its agent approaches a small business and offers a loan. The paperwork shows that the loan comes from an FDIC-supervised bank, Bank of Lake Mills or Liberty Bank, or OCC-supervised Axos Bank. But the bank quickly assigns the loan back to World Business Lenders. These loans, ranging from $20,000 to $400,000, are secured by a mortgage on the home of the small business owner at astonishing rates. 72% for a general contractor in Florida, 73% for a New York owner of a medical supply company, 92% APR for a couple in Massachusetts. Many of these small business owners are facing foreclosure, like a realtor in New York who was buried by a $90,000 mortgage at 138% APR. Many states prohibit these rates on second mortgages by non-bank lenders. But World Business Lenders argues that as the bank's assignee, it can charge outrageous rates. This is the lender that the OCC and the FDIC are supporting with the same arguments that they are using to justify their proposed new interest rate rules. These proposed rules are in no way necessary to address legitimate secondary markets. We see no problem in those markets. What we do see is an explosion of predatory rent-a-bank lending undermining power that states have had for nearly 250 years. The FDIC's and the OCC's support for World Business Lenders tells us exactly who is eager to step into the bank's shoes: predatory lenders. So what can Congress do? First and foremost, pass H.R. 5050, the Veterans and Consumers Fair Credit Act, to cover all lenders, banks and non-banks, with a 36% interest rate cap. That is still a high rate, and the bill will not stop all evasions to state usury laws. But an upper limit of 36% will cut off the most egregious abuses of the bank charter to facilitate predatory lending. Second, stop the FDIC and the OCC from facilitating rent-a-bank lending and support states' historic power to limit interest rates. Third, pass H.R. 1423, the Forced Arbitration and Justice Repeal Act, which will restore consumers and small businesses access to the courts when predatory lenders violate the law. Thank you for inviting me to testify today. I look forward to your questions.
Thank you for your testimony. Now, Mr. Knight, you're recognized for 5 minutes.
Thank you. Thank you. Good morning, Chairwoman Waters, Subcommittee Chair Meeks, Ranking Member McHenry, and members of the committee. Thank you for inviting me to testify today. My name is Brian Knight, and I'm the Director of the Program on Innovation and Governance and a Senior Research Fellow at the Mercatus Center at George Mason University. Much of my research focuses on the role of technological innovation in the provision of financial services. The key point I want to leave you with is that innovation and competition in lending, of which the bank partnership model is a key part, is helping to improve access to credit, especially for borrowers poorly served by the traditional market. We are witnessing an important evolution in the credit markets, powered by innovative firms partnering with banks, frequently smaller banks. Fintech firms, many partnering with banks, now account for 38% of unsecured personal loan balances, up from only 5% 5 years ago. There is evidence that these partnerships allow some borrowers to access credit on better terms than they would receive from a traditional lender. There is also evidence that these partnerships allow for greater access to credit for borrowers in parts of the country that are underserved by traditional lenders, and that innovative lending can be less racially discriminatory than traditional lending. These partnerships are mutually beneficial for both the fintech firm and the bank. The bank receives access to technology beyond what it could develop on its own, customers outside of its immediate geographic area, helping it to diversify its business, better management of its balance sheet, and enhanced servicing capacity. Fintech firms receive assistance with regulatory compliance and the ability to do business nationwide under a consistent regulatory regime in conjunction with their bank partner. It is important to keep in mind that these relationships are highly regulated. Fintech firms that partner with banks are frequently regulated under the Bank Services Company Act and are subject to examination by the bank's federal regulator for the services the fintech firm provides to the bank. Additionally, the fintech partner is frequently subject to examination by a state bank regulator if the partner bank is state chartered, and is covered by consumer protection laws enforced by the Consumer Financial Protection Bureau and the Federal Trade Commission. Likewise, the bank is accountable for the actions of its fintech partner taken in furtherance of that partnership. Bank regulators have shown themselves to be willing and able to police bank partnerships and hold both banks and their partners accountable for bad acts. While these partnerships between banks and innovative technology companies have displayed significant promise, they have been threatened by recent litigation that has disrupted long-settled expectations. In the case of Madden versus Midland Funding, the United States Court of Appeals for the Second Circuit held that New York law governed a loan that was originally issued validly by a bank under Delaware law, and therefore the loan was usurious when it was sold to a debt collector after default. In effect, the court held that the legality of a validly made loan could change depending on who held it after it was made, even if the terms of the loan itself did not change. This holding has been criticized as an incorrect interpretation of the law by the Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency, and the Obama administration Solicitor General. While this case does not directly deal with the type of bank partnership at the heart of innovative lending, it appears to have had a significant and negative impact on credit markets because it calls into question the ability of banks to sell their loans to fintech partners. One study found that, in the wake of the Madden decision, funding for marketplace loans aimed at borrowers with FICO scores under 700 decreased significantly in New York and Connecticut compared to outside the Second Circuit because of concerns that any loan made to those borrowers may become invalid if sold to a non-bank marketplace lender. A subsequent study found a reduction in marketplace lending credit availability to New York and Connecticut residents, especially low-income residents, as well as an increase in personal bankruptcies, a phenomena that the authors of the study linked to the inability of low-income borrowers to access credit in order to refinance debt or address exigent circumstances like medical bills. These unfortunate results highlight the potential harm of impeding increased innovation and competition in credit markets. Consumer protection is essential, but denying consumers access to credit does not necessarily protect them because it does not remove the underlying issues motivating the need for credit. Rather, allowing more innovation and competition in credit markets, especially to those insufficiently served by traditional products, presents a better path to what we all want, a credit market that allows consumers to make informed choices that best serve their needs. Thank you again for the opportunity to testify, and I look forward to your questions.
Thank you, and thank all of the witnesses for their testimony. I now recognize myself for 5 minutes. Your testimony today has been very good, and I'm sitting here listening and trying to dig through where and what would be the best way to go. One of the things that I've been trying to do, especially in the subcommittee, is try to make sure that there's access to credit in low and moderate incomes, and we have found to a large degree that that came from minority MDIs, minority depository institutions. There's only 20 left today, and during that hearing that we had, there was 20 that are left. And for me, and I agree with what most of you said, when you look at payday lending and the title and the pawn shops, especially when it comes to small dollar loans, that's where folks in my community go when they try to borrow some money. And generally, the MDIs have more accessibility in working with them. When they testified here, they said that it may be better for them to have partnerships, especially with dealing with technology. So my question will go to Ms. Johnson first. How do we, I don't know whether your research had showed what effect this would have on minority depository institutions in regards to if there was a rate cap at 36%, would that 36%, what effect would that have on their viability remaining in the community, and or what other incentives can be utilized so that they can feel it is okay to do business with a small dollar loan with a lower interest rate?
So if I understand your question correctly, you're asking what impact would an interest rate cap have in minority communities?
Minority depository institutions, black, minority banks,
Right.
and communities.
So my research does not deal specifically with those type of organizations, and I didn't know if any of my colleagues could speak to that.
Ms. Aponte-Diaz, do you?
Hello. I can speak to our credit union, so our partner, Self-Help Federal Credit Union, offers loans capped at 18% and are able to do that we did a special program for DACA recipients at 18% at the top, depending on their credit, and we're able to do that and provide lower interest rate loans for
And is that for small dollar loans?
small dollar loans. Yeah, DACA loan is about $600.
So let me ask another question, because one of the things that I had hoped back when we had the financial crisis and we created the CFPB that we would have someone that would be fighting for consumers. Unfortunately, I think that we've moved back from, say, some of the rules that was being put down by Director Cordroy's. So under Director Cordroy's CFPB, particularly for payday rule, it was anchored by two pillars: ability to repay, which is tremendously important, you know, and that's what got us in trouble before, these no-doc loans, and capping at 3 the number of loans that lenders could make in quick succession. He was indicating that this would get at the heart of the payday industry's debt trap business model. So I guess, Assemblymember Limón, what would you say about what the CFPB was saying under Director Cordroy's leadership?
Thank you. So I do want to comment on your previous. I can tell you that with the state law in California that was passed at 36% plus federal rate, we still have a $2 billion industry for just California alone. I can't tell you how many of those are minority-owned banks, but the space is still there for lending. So I want to be clear that there's still some options. And as far as Director Cordroy's direction for the ability to repay, underwriting is absolutely important to this space and to this market. And certainly capping the number of loans that people take out at a time is another way to address this. These are elements that we've explored in the state of California and elements that we're supportive of. They're not written into the law that was passed, but they're different elements that can further address the security of ensuring
So
payback.
if he was still here, or the rules that he was putting in place, do you believe it would have been a failure or a success in the rule as he had outlined it?
Success.
I'm out of time, and so I now recognize the gentleman from California, the ranking member from North Carolina,
Very different. We're getting
You
some
gave him a
California
promotion.
jobs,
Mr.
though.
McHenry.
So we're getting some California jobs, though, so grateful for that. Anyway, Mr. Knight, in your written testimony, you speak of the spread of the bank fintech partnership model as having a number of benefits, including better credit terms for consumers, improved access, some of the technological advantages that we see in other areas of outside of consumer lending, right? So that interface question, there are a lot of benefits afforded to this model. But looking at this, in 2015, the Second Circuit had a ruling in Madden versus Midland that a loan to a New York resident was valid when it was made by a bank became invalid once it was sold by the bank to a non-bank third party, right? So this came as a surprise to many. Why?
Well, because it upset a well-settled expectation that, one, banks can sell loans, that's a power of a bank, and that the loan, they can sell the loan and the loan remains valid, and that's an important criteria.
Why can they sell the loan?
Well, they need to sell a loan for a host of reasons. Balance sheet management, risk management. I mean, in the case of Madden, this loan had gone into default, so they wanted to move it off of their balance sheet so they could shed the risk. There is a profitability argument there, particularly for smaller banks who don't necessarily have the deposit base to sit on a whole bunch of loans. So, you know, it's long been recognized that selling a loan is part and parcel of being a bank. And then, so that's the ability to sell the loan as a bank prong. The second prong, which the Second Circuit really didn't deal with, is the common law of valid when made doctrine, which generally says that a loan, if it's valid when it's made, does not become usurious because of a downstream transaction.
Okay, so is that a payday issue, a payday lending issue of valid when made? Is that all this is about?
No.
Okay.
This applies
To every loan?
every loan.
Okay.
And
a loan is an asset on a bank's balance sheet.
correct.
Right. So the issue of valid when made is how old? How long-standing is this practice?
Well, so, I mean, the early 19th century court cases refer to it as this longstanding maxim. So I don't know how far back it goes.
So how does this strike the banking system if this becomes the national norm?
Well, it could severely limit the ability of a bank to sell a loan, because under the logic of the Madden decision, the bank could only sell the loan and have it remain valid if the recipient could have made that loan themselves. And so in that case, you basically have banks selling to other banks, and not just any bank. It would have to be a bank that under that bank's home state law could have made that loan, which means, one, you can't move that risk outside the banking system. You're just trading it among banks. And two, that significantly diminishes the ability of a bank to sell a loan at what should be its appropriate market value.
Okay. So, but this issue gets conflated with a number of issues that are hotly litigated across states. Is that not the case?
Right. Valid when made has been conflated with the ability of a bank to sell a loan statutorily, and it's been conflated with the true lender doctrine. And they're all related, but they're also all distinct.
Okay, true lender, what is true lender?
So valid when made is about what happens to the loan after it's sold, because if the loan isn't valid in the first place, valid when made doesn't apply. True lender is a emerging doctrine that even if the bank technically makes a loan, it's not considered the true lender under certain circumstances by some courts. And the emerging doctrine is a predominant economic interest test. So if the bank does not have the predominant economic interest test in the loan when the loan is made or shortly thereafter, some courts will say, well, then bank, you weren't the true lender. The party that has the predominant economic interest was in fact the true lender, and so we will look to see if that party could have made the loan valid.
Okay, so resolving this issue of valid when made is distinct from true lender.
Yes, it is.
Okay. And to this end, what we've seen at the Second Circuit jurisdictions of New York, Connecticut, and Vermont is the availability of credit is gone down. We've seen rates go up, and it's had a negative effect on consumers. And that is according to the Stanford, Columbia, and Fordham study of this. Is that correct?
Both that study and a subsequent study.
Thank you. Yield back.
Gentleman's time has expired. I now recognize the gentleman from California this time, Mr. Sherman, who is also the chair for the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets. You're now recognized for 5 minutes.
Thank you. It's interesting to see the argument made that if fewer payday loans are made, consumers are hurt. That jumps to a conclusion. But the fact is that the wages are too damn low. People often are knowledgeable but poor. What are you going to do? Sell your truck, rely on overdraft protection, fall behind on your rent, or go to one of these payday loans or similar loans. APR, I don't think, is the best way to evaluate the cost of short-term loans. I think the minority made that point. For example, I pay a $2 fee to use a particular ATM. If I spent 15 minutes extra time, I could go to my own bank's ATM. So I'm borrowing the money for $200 for 15 minutes, paying $2 to do that. That's about 100,000% interest. It's not because the bank is getting a fair fee. The owner of the machine's getting a fair fee. They got to have the machine there. They're entitled to what I think is a fair fee to save me from having to wait for my money for another 15 minutes. The position of the OCC seems outrageous when they say that they can adopt any regulation to facilitate banks' ability to operate across state lines. I'll throw out one example. Are we going to have a position where if a bank makes a loan on a piece of real estate, that state and local law can't change the zoning of that real estate because that would hurt the bank? And then if a bank ever were to make a loan, then forever that property would be exempt from downzoning. The OCC is taking an outrageous position on this, but they want us to listen to them on LIBOR and other issues. The OCC's position is, well, if you're a bank, you're not going to be subject to state and local regulation to protect consumers, and we're going to make sure that there's no federal protection for consumers. And no matter, you know, and if you engage in a business practice to roll over the loan 26 times a year, year after year, well, that's just fine as long as a bank is involved and is making some money, and we're facilitating banks and making banks more profitable. Let me ask my own California Assembly member. We've taken some real actions in California. What do people do when they need money to pay to keep the lights on?
People still have access to credit. As I mentioned, there is still a $2 billion credit space in California under the rate cap.
Is that $2 billion of all consumer loans, or how do you
For small dollar lending.
Small dollar lending, not credit cards.
Small dollar lending.
And when you say small, you mean under 5,000, under 2,000, under what?
Under 10,000.
Under 10,000. A lot of a lot of people. What about? Is there space there for people who need to borrow 500? Because I'd hate to borrow 5,000 if I needed 500.
Under 10,000 includes the 500.
Yeah, but is there a vibrant industry in California where I can get a $500 loan if I don't need a $10,000 loan?
There is an industry. And regrettably, the industry at this moment for 300 and under and above, if it's under the 36%, it's a very healthy one. We haven't done anything about addressing payday proper. The bill that we've passed in California is about the $2,500 to $10,000 space, which is the highest used product, the highest growing product in the state of California.
I would point out to my colleagues that it looks like OCC wants to push this reg through, but a provision on an appropriations bill preventing them from doing that would be the best way to make sure that we don't have a situation as we do today, that there's no federal regulation and an agency dedicated to making more money for banks is going to allow them to evade California law and other law. It'd be one thing if OCC was applying this after we in Congress consider the Garcia bill and others and have reasonable federal rules. Then the OCC would be saying, well, you're a bank, that means national usury. But to have a zero consumer protection rule for everything in small dollar shows that the OCC needs to be reined in, hopefully by a provision on the appropriations bill. I'll yield back.
Gentleman's time has expired. I now recognize the gentlewoman from Missouri, Ms. Wagner, for 5 minutes.
I thank the chair. According to a 2017 survey by the FDIC, 25% of U.S. households, or 32 million Americans, I say again, 32 million Americans, are either unbanked or underbanked. These households might have a checking or a savings account, but they also obtain financial products and services outside of the formal banking system. A minority of these households do not even have a bank account with an insured institution. Lack of access to banking continues to worsen as branches close across our country. Access to safe and affordable financial services is absolutely critical, especially among families with limited wealth, whether they're looking to invest in education or simply manage the ups and downs of life. Mr. Knight, in your testimony, you stated that the bank partnership model allows for greater access to credit for borrowers in parts of the country that are underserved by traditional lenders. Could you please elaborate more on how these partnerships help those without access to mainstream banking services?
Absolutely. Thank you for that question, ma'am. So based upon the research I've seen, where the partnerships bear fruit is that a relatively modest-sized bank that could never make the sort of financial commitment to build out their technology on their own is able to partner with a technology firm that is able to put forward a internet platform that can penetrate just about anywhere, particularly with the increasing penetration of the internet and smart devices. And that enables borrowers who are in areas where maybe banks have retrenched or are otherwise underserved to access relatively high-quality credit over the internet, who couldn't necessarily do that via a traditional bank branch model. And so that allows your modest-sized bank, who's good at banking but not so great at technology and scope, to partner with a fintech company that's great at technology and scope and not a bank, and it's two great tastes that often taste great together.
So you've given us kind of the outline of how the pieces put together in terms of this bank partnership. How does the actual constituent benefit? How does this model work for them, those that are in fact underserved in so many of these communities?
Well, so first, it gives them more options and more potential lenders competing for their business. And so competition has been shown to frequently drive down prices in credit.
Drives down prices in
Yes.
credit. Mm-hmm.
You will also see, and there is evidence that many of these firms are using innovative underwriting to better serve groups that are not necessarily well served by your traditional FICO-based underwriting model. So for those groups, they will see better underwriting that is both more accurate and also frequently cheaper. Then they have ease of access and convenience, and then it can often be relatively quick to access these loans.
So they can get that money when they need it expeditiously for the, as I call them, the ups and downs of life.
That's correct, and you know, an example from the small business space is that one of the things that these small business loans, and to be completely clear, on the small business side, these loans are often more expensive than a small business bank loan. But a lot of these businesses could not get a small business bank loan because they need less money, and the bank would take much, much longer to approve the loan, so they're paying for convenience and a right-sized loan.
In my limited time, is it possible for banks to evade state law if they have bank preemption?
No, they're operating on the basis of federal law, and Congress has made a choice to grant both state and federal banks certain authorities.
And you've already talked about what will happen to access to affordable credit if bank partnerships are prohibited to Congress. It will go away, is that correct?
It would certainly be crimped.
And who would step in to fill that void?
Well, probably an alternative provider or an illegal provider, or no
Legal
one would step in.
provider. Thank you, my time's
The lady's
expired.
time is out. The gentleman from Georgia, Mr. Scott, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I want to follow up on point of questioning that I agree with Chairman Meeks and also my colleagues, Mr. Sherman and Ms. Wagner. For we have been working on this committee for many years against predatory lending. But what we found out is that we need to do a rifle approach to solving this problem and not a scattergun that could bring innocent bystanders in that are actually out here doing a remarkable job providing credit access and lending to the very people that we are concerned about avoiding from the predatory lenders. Let me start with you, Ms. Limón. When it comes to the creation of new financial products, are there not other pro-consumer features to products that policymakers should focus on beyond the APR? Things like fee transparency, limitation on debt rollovers. Are those not also important aspects for us to explore as we look to incent innovation and expand services to the unbanked and underserved?
Yes, those are also important elements to consider.
And now, let me get to the heart of the matter here. In your written testimony, you describe feedback from some lenders in your state stating that they preferred an interest rate cap to underwriting guardrails. Our concern on this committee is around access to credit. And I've heard from lenders, I've heard from online lenders, I've heard from banks, and as my chairman, Mr. Meeks, mentioned, we've had our African-American bankers here, of which we've not had a new African-American bank in a quarter of a century, who are very concerned about this rate cap and their ability to provide access to credit for the very people that we want. They feel that they may be unable to fulfill demand for credit under such circumstances, particularly for the low-income consumers who are already having many challenges. I call your attention to a 2018 study by the World Bank that found that binding interest rate caps below market values can reduce overall credit supply. I'm sure you may be familiar with that. A separate study looking at the experience in Chile found that the impact was felt most profoundly by the youngest, least educated, and poorest families, the very families that you and I both are concerned about. And also, let me add this, because of the underwriting costs are strained by the rate cap, the lender must make larger loans in order to make the loan profitable. This means that consumers may take out a larger loan than they need, which can place our consumers in a financially precarious position. And the rate cap extends broadly to most types of credit and is not narrowly targeted. That's our concern to the payday lenders. And rate caps cause a loss of credit availability, particularly for non-prime, subprime consumers who pose greater risk at the default. And this is because the lender cannot afford to offset the underwriting costs due to the rate cap. So all I'm saying is that we can't dismiss these concerns. We got to deal with them. So what I want to kind of hear from you, Ms. Limón, on this, what information did you have prior to passing your law that led you to believe the rate cap would not restrict access to credit?
The very principle of our law is that high interest rates caused higher defaults for the very same families that we are trying to serve. And so that is a concern. We saw over 20,000 Californians have a car repossessed and over 100,000 Californians go into default because of these loans.
And
The gentleman's time has expired.
All right. On 007. Thank you, sir.
The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Well, thank you, Chairman. Our topic today illustrates one of the great paradoxes of regulation. On the one hand, governments have sought to regulate prices to protect consumers, only to find out that doing that restricts the supply of the good or service and actually hurts those they seek to protect. And, you know, in an everyday perspective, I mean, a lot of consumers would jump for joy if Congress passed a law that said you couldn't charge over $1 a gallon for gasoline. A lot of people would be real excited to say you really did the right thing. But we know what would happen, don't we? You would have zero gasoline. And so, you know, is it better to pay more than $1 for a gallon of gasoline or not have any gasoline? In that regard, I ask unanimous consent to enter into the record a 1970 Newsweek article by the late Milton Friedman entitled Defense of Usury. There are two more items that I'd...
Without objection.
Thank you, Chairman. There are two more items I'd like to put in the record. The first is Rolf Nugent's classic paper that appeared in a Harvard Business Review in 1930 that showed how half percentage reductions in maximum interest rates across 3 states was correlated with funding for small loan needs of low-income people and the unfortunate growth in bootleg lenders.
Without objection.
Thank you, Chairman. And finally, a 1975 paper from the Florida State University Law Review that details the history of small loan regulation in Florida. This paper details the ways the market innovators got around rate ceilings. The articles will help remind us that regulating small dollar loans have a wide range of unintended consequences, including denying many low-income people the loans that they need. These papers also underscore another important aspect of our hearing, and that's regulatory arbitrage. Interest rate caps in one or more states make incentives for market lenders to innovate to make loans to residents of those states who need them. They have done this in partnership with banks in other states. Mr. Knight, what role do small dollar lenders or loans play in our economy? Do they provide essential financial services?
Yeah, so small dollar credit can provide essential financial services for borrowers. There's definitely evidence. I should say that for small dollar credit, particularly say storefront payday, the economic evidence is mixed as to whether or not access is a good thing or a bad thing, but it's pretty clear that for at least some borrowers, it can be absolutely essential.
Okay. I believe that the regulation of interest rates, as I mentioned, is a real paradox. And some states seek to protect consumers, and they make money unavailable to them, unfortunately. This two-edged sword is difficult to balance sometimes. And so, which aspects do you believe is more important, protecting from high interest rates or protecting from credit scarcity?
I believe that protecting from credit scarcity is frequently more important. I believe that in a functioning, competitive, and well-regulated market, I mean, there is definitely a role for regulation to play, consumers should be able to access credit and that they will be able to address their credit needs because frequently they're accessing credit to avoid a greater harm. There's always the option to not take a loan, but if you're taking a loan to avoid a greater harm, that loan should be available to you.
The CFPB has delayed the ability to repay or mandatory underwriting provisions until November. CFPB originally proposed to rescind the entire rule. Can you evaluate the underwriting provisions in terms of its benefits, costs, and impact on consumer credit availability?
Sir, I'm afraid I cannot do that. I have not done a sufficient study of that to have an informed opinion.
Okay. In fairness, lady on the front end from California, do you want to respond?
I'm sorry, can you repeat the question that you'd like me to respond to?
Yeah. It was talking about the delay of the CFPB rule, that they had the ability to pay rule.
So my comments on, we would like to see that in California, and that has actually been a challenge to us, and part, not full, but part of the reason we also stepped up to pass our own rate cap law.
Okay. Thank you very much. Mr. Chairman, I see my time has expired.
The gentleman yields back. The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank all of the participants today for sharing with us your ideas. Let me first of all ask Chair Limón. In addition to your work on predatory lending, you've also been leading a conversation in California about strengthening the oversight authority of the state financial regulator, particularly in light of the Trump administration's efforts to weaken consumer financial protections and the CFPB's role in enforcement. So can you talk briefly about why California feels the need to act and what you hope to accomplish by strengthening the state's role in protecting consumers in the financial marketplace?
Thank you. Last year, I introduced a bill that would have developed a California version of the CFPB. In light of the federal administration taking action on some of the work that we expected to be coming down, California has really seen a need to step up. With almost 40 million people in the state of California, we know that we are a big portion of the market share for a lot of this lending space, and so we feel it's very important to protect consumers, and as a state, we have had to step up in the absence of federal oversight and regulation.
Okay, so it's my understanding that California had been trying for a number of years to get a rate cap in place What do you think were the key components of your efforts last year to get the bill over the finish line? And was there bipartisan support for the new California law?
Thank you. There was strong bipartisan support for this bill, and we built a coalition that I think was very strong. So over 2 decades of having this conversation, multiple bills introduced in the last 3 years, we put together a coalition that included veterans groups, the Urban League. We had many groups at the table, including responsible lenders who told us time and time again that they could work within the interest cap rate and provided options for consumers in California.
Okay, well, great. I served in the North Carolina House for about 20 years, so I understand how important it is to bring stakeholders to the table. Otherwise, they say you're on the menu, but thank you for that. So, Ms. Saunders, NCLC has previously highlighted some high-cost mortgage loans as high as 138% APR made to small business owners through a rent-a-bank scheme. Would you please tell us more about these loans, the terms, and the circumstances in which they were made?
Sure. So first mortgage loans are deregulated, and there is no rate cap. But many states do limit the rates for second mortgages. And yet there is a non-bank lender, World Business Lender, that is using a couple of banks, OCC-supervised Axos Bank, and in the past, FDIC-supervised Bank of Lake Mills in Wisconsin, to entrap small business owners with really horrendous loans. For example, Jacob Adani in New York was, looking for a personal loan, but he was forced to reference his business in the loan documents. He ended up with a $90,000 loan at 138%, and he's facing foreclosure. And that's an illegal loan in New York, but the claim is that because the loan was, the paperwork showed it came from a bank and then it was assigned back to the lender, that makes it legal. Alyssa Spear is facing foreclosure in Connecticut because of a $20,000 loan at 121%, supposedly for her restaurant, which she didn't own a restaurant, but they trumped up these loan documents claiming that a leaf blower was equipment for a restaurant. These are the kinds of things that we are seeing predatory lenders do using banks as a fig leaf.
All right, thanks very much. Ms. Saunders, where are we now with the ability to repay standard in the 2017 rule? Is it important for us to fight for this, and what other features are necessary?
It is absolutely necessary for us to fight for it. In the absence of a rate cap, the CFPB's ability to repay rule, a very modest rule that simply caps the number of loans and has a common sense rule that lenders should consider a person's ability to repay, should go into effect. It's been stayed by the court. The CFPB has threatened to repeal it, and we need to put it into effect.
Thank you. Ms. Aponte-Diaz, Director Cranger will be appearing before our committee tomorrow. What question would you recommend we ask her about these issues? We've got 20 seconds.
For Ms. Craninger?
Yes.
She was on the board that approved the FDIC proposed rule, so we would ask her to rescind that rule and also to move forward with the ability to repay payday rule.
Great. Thank you very much. Mr. Chair, you're back.
Gentlelady's time has expired. I now recognize the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Ms. Limón, you made a statement a minute ago. You've been talking about your bill from California. My understanding is that the bill was signed October 11th, 2019. Is that correct?
Yeah.
And it only regulates loans between $2,500 and $10,000. Is that correct?
That's correct.
Okay. Mr. Sherman from California asked you about the $300 loans a while ago, and I didn't really hear you giving a good answer to that. You don't regulate the $300 loans, though. Is that correct?
We have not done anything around payday.
Okay. Which that was not the impression we got from your testimony and your earlier comments. Also, you said that you got a $2 billion industry. Well, have you studied, and I doubt that you have, since the most you could have studied would be 4 months here since this law is signed. Have you seen what kind of effect it's had on small dollar lending yet?
So the $2 billion that I reference is the lenders that are lending within the rate cap. So just to be clear, the industry is bigger.
I mean, have you seen an effect on this? I imagine you don't have at this point.
So this, the data will not come out for another year.
Okay, so we really can't say whether it has or has not helped it at this point.
What I can say is what the existing market is under the rate cap, and that's $2 billion.
All right, very good. Well, my concern is, and I think you found the sweet spot there, because the George Washington University study says that the break-even point for a 36% APR is $2,600. So you're aware the break-even point is. So it's interesting that you've got that. Also, there's a UK study that my good friend from Georgia, I think he was referencing here. UK put into effect in 2015 100% rate cap, and then the Financial Conduct Authority did an assessment on it and found that the value and number of short-term dollar loans fell 50% in 6 months. I'm guessing you're going to see a significant decline in loans in this $2,500 to $10,000 area as well. You know, one of the things that concerns me is the misrepresentation of the cost of a loan. APR, in my judgment, if you're talking about a loan that's less than 1 year, is irrelevant. And I'll give you an example. If you got a leaky faucet in your house, you call the plumber up, comes out, turns the tap, 10 minutes later he walks out the door, hands you a bill for $50. Now, was that a surcharge, Ms. Saunders, or did he charge you $300 an hour for that service?
You know, I think that the rent-a-bank loans that we are talking about.
I'm not talking. I'm asking you a question. Is it a surcharge? Is it a service charge for him coming to your home with his truck, his equipment, his knowledge, his tools, fixing your faucet, or did he charge you $300 an hour?
Well, he hasn't offered you a loan, so no, it's not an interest rate.
Can I add something?
That's not the question I ask. I ask whether he's charging you by the hour or he's charging a service charge.
You know, people charge in various ways. You can charge by the hour, you can charge a surcharge. And
Okay,
yes,
you don't want to
that's a
answer the question. The answer is it's a service charge, which is exactly what any kind of a loan less than a year should be. It should be disclosed in a service charge. I would argue that you're hiding the true cost of a loan by hiding behind an APR, because that customer doesn't know what the true cost of it is. If it's $5, $100, $10, $100, $20, $100, whatever it is, if you don't disclose that in a way they can understand, they'll never know. Who knows what a 200% rate? Let me give you an example. You got a $400 loan, which is the average that most people can't afford cover anymore. And if you charge them $20, you guys know off the top of your head what kind of interest rate that would be?
It depends on how long it's been.
Over 14 days, 2 weeks. That's the normal rate.
$20 for a $400 loan?
Yeah, 14 days.
You know, on pressure, I can't do the math. I
Okay,
can
it's
tell you
120.
that 15 for 100
Okay,
is
it's 120%.
91.
Okay, it's 120%.
Okay.
A while ago, we just established that the average is going to cost you $35. So here we have a loan that's below the cost. You think they're going to make that loan if it's below the cost?
You know, what they'll probably do is make a better loan that's a longer-term loan that gives you time to pay it back.
No, the customer doesn't want
to.
See, that's the problem that you're getting into here. You're trying to drag them into something different. The customer just walks in, wants a $14 loan until it gets payday, and I'll show you here in just a minute. There's a reason for this. And if you only use that amount of money, that's all you want. Why should you drag the customer into something they don't want? That's my concern.
APRs give people the ability to compare the same amount of money.
APRs hide the true cost of the loan. I would argue that they'll help.
And I would argue the other way around, because it's usually 10
Professor Johnson, I've just got a comment for you before we end my testimony here. You're talking about having gone out and surveyed some different payday loan institutions. I would recommend to you for reading The Unbanking of America by Lisa Servan. She went out and did 4 months in 2 separate locations with check cashers and payday lenders, had the same sort of preconditioned, pre-thought process that you have displayed today with regards to your testimony, and came in with a completely different view of what happened. I suggest that.
Gentleman's time has expired.
Thank you very much, Mr. Chairman.
The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you. Professor Johnson, who funded your research? The university, academics. So I think really pay attention of who's funding various research and books and things of that nature. I want to focus on the truth today. We are calling this rent-a-bank method, correct?
Yes.
When someone is intentionally committing an act that is clearly illegal and uses someone else to do it, isn't that still a crime?
Yes.
So the truth is the rent-a-bank is actually a criminal scheme.
Yes.
Correct?
Correct.
Yes? Do you not agree, Mr. Knight?
So it depends on the nature of the interaction.
Got it.
So I don't want to give you a misleading answer.
That's
The lawsuit
okay.
filed
I
by-
will make sure to tell my son that hiding behind someone else when it's actually a crime, he is part of the crime. He is still part of a criminal scheme if he does that. So you can all continue to say it depends, but the truth is you have state law that is being circumvented by these banks that are really targeting the most vulnerable communities, people that we represent. We're not here representing the banks and big corporations. We're elected by people, not them. On December 5th and 6th, the federal FDIC chairwoman McWilliams had testified before various committees and was asked several questions about FDIC supervised banks that are helping high-cost lenders evade state interest, these terminologies, really to commit crimes, to basically sit back and watch them do it. Whether or not their proposal that they submitted encourages those criminal schemes. I specifically asked the chairwoman about these criminal schemes happening in my state and where we have really strong, in Michigan, really strong interest caps. And it's really important. We have a huge amount of working class, middle class families that are being targeted. But Chairwoman McWilliams said the agency, quote, frowns upon arrangements between banks and non-bank lenders for the sole purpose of evading state law. Great. Let's see that in action, right? So, Ms. Aponte-Diaz, does this satisfy your concerns about this so-called, rent-a-bank criminal scheme is what I'm going to be calling it because that's the truth?
Absolutely not. It's been lip service to date. There have been no enforcement actions on these rent-a-bank schemes from the FDIC, and the proposed rule actually is going to embolden predatory lenders to enter into more rent-a-bank schemes. And if you don't mind, if I just wanted to add to the many questions around access to credit, we recently did a study in South Dakota where voters, through a ballot initiative, voted 77% that they wanted a 36% rate cap. We came back 3 years later to ask folks how they felt about that, and 82% of the folks in the poll said that they are very happy with the 36%. They wouldn't change it. We saw still an increase in lending, an increase, not just stable, but an increase in lending in South Dakota. And so I just wanted to add that as well.
No, and I think, Ms. Aponte-Diaz, we can do a lot of polling and surveys that seem not to matter here. And it's the truth. Seems to me this lack of sense of urgency of trying to help middle-class families not become targets of these criminal schemes. It may be corporations, it may be folks, but I'll tell you, my residents, they get labeled these kinds of really awful, names and so forth and kind of brushing them off. But boy, if it's a corporation, a CEO, a bank, a predatory lender, it seems like we kind of give them a pass. And I feel very strongly about this. Do you think FDIC's McWilliams is being straight with Congress about the criminal rent-a-bank scheme when I believe it was, quote, it's up to states to decide what the rate caps are appropriate, if any, or whether or not the states want to opt out of that ability of the interest rates to be preserved when out-of-state entity purchases the loan product. There's a lot of stuff here, but it's because, this, the Utah bank, say Utah bank could simply claim that the loan was made in Utah because that's where the charges are imposed, payment is sent, but it's really in the fine print of the contract. It literally is on paper that they're circumventing the law. It's like, look, it's blatantly in your face, a criminal scheme. Yeah. What more can we do? Because it's very obvious that's exactly what's happening.
Yeah. No, the chairwoman McWilliams mentioned this opt-out, but states should not have to opt out. California spent 3 years through the democratic process. Yes. Colorado, South Dakota through the ballot initiative. We should not have to go through these extra steps. The FDIC should step up.
It undermines.
The gentlelady's time has expired.
Thank you, Chairman. Thank you.
The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you. I'm stunned. I've never heard interest rate preemption that's specifically authorized under federal law, the National Banking Act, and the Federal Deposit Insurance Act ever described as a criminal scheme. But nevertheless, I learn something new every day here. Mr. Knight, many of the other witnesses here today have offered this narrative that banks and these partnerships are merely passive participants who allow bad actors to use their charters to prey on consumers. The title of this hearing, in fact, suggests that banks play no significant role in these partnerships. But in reality, the relationships we're discussing today are genuinely innovative partnerships that allow banks to provide access to credit to portions of the population previously underserved by financial institutions or stuck with predatory payday lenders, check cashing businesses, or pawn shops. In many cases, banks provide significant value to both their partners and the consumers, including by developing underwriting standards, retaining a portion of the risk on their books, and maintaining high standards of customer service. Would you please discuss how banks play an important active role in these bank fintech partnerships that we're discussing today, and discuss how banks have skin in the game?
Yes, thank you very much. So, yeah, I think that there is a concern that these partnerships are basically a bank handing a non-bank lender a stack of stationery and saying, go for it. And if that is the case, that's against the law, and the regulators already have tools to police it. In reality, many of these partnerships are a collaborative effort between a bank and what amounts to sort of a vendor who can help them from a technology perspective, from an underwriting perspective with the utilization of technology, from a marketing perspective, and then from a balance sheet management perspective, which are things that banks contract to third parties with all the time.
And then banks have additional capital, and they have underwriting expertise.
They have capital, they have underwriting expertise, they have regulatory expertise, they have the ability to help the fintech firm manage the efforts.
Well, let's just follow the logic of the critics that this is truly only passive conduct on the part of the bank. And I think by passivity, they mean the loans are not kept in portfolio. But banks are passive in a number of other asset classes, and I don't hear our witnesses leveling charges of renta bank for these activities. Consider a mortgage. Fannie and Freddie have very specific rules for what kinds of paper they will buy. Are they involved in a renta bank when they insist on specific loan terms for mortgages and then purchase them a few days after the loans are extended? Should we shut down that system and insist that Fannie and Freddie enter the direct lending market?
No.
Okay. Let me ask you, Mr. Knight, in your testimony, you note that the Madden decision resulted in the reduction of credit availability to residents in states within the Second Circuit, and that the rate of personal bankruptcy filings increased due to a lack of available funding options for borrowers. Would the FDIC and the OCC's proposed rules to clarify valid when made help reverse these credit availability issues?
They would help.
And tell me, what would happen to the credit markets, particularly in terms of liquidity, when originators and purchasers of loans are not certain about the permissible interest rate for those loans?
I mean, I think what we're seeing is that it dries up. And particularly for the riskier loans, the loans that would have to be priced at a somewhat higher interest rate because there's concerns about their validity. People are not going to invest money in a loan that they're not certain will remain valid.
So the vibrancy of a secondary market is directly contingent upon the valid when made doctrine.
Well, some combination of the valid when made doctrine and the ability of a bank to sell a loan and have it remain valid, which is a statutory power. And sir, if I may note one more important thing in the bank partnership, that the bank has to own the credit model. The bank has to be the ultimate decision-making party. They own that regulatorily. They are responsible for the loans that are made. And if it isn't that way, that's against the law, and they're in trouble, and there are tools available to police that already, and the FDIC and the OCC have shown a willingness to do so.
Mr. Knight, final question. I represent a relatively rural district. I have some urban and suburban parts of my district as well, but I do think about my rural constituents a lot in the context of access to financial services. And a recent Federal Reserve study shows that 51% of the counties in the U.S. saw net declines in the number of bank branches between 2012 and 2017, and these declines in bank branches disproportionately hit rural communities. Another report by researchers from the Fed found that online fintech lending has penetrated areas that could benefit from additional credit supply, including those areas that have lost bank branches. As banks are closing and consolidating, how are fintech bank partnerships able to fill the void and service rural customers?
The gentleman's time has expired. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. It seems there is no lack of creativity when it comes to the financial industry's desire to exploit those facing hardship. To be clear, unless you believe that poverty is a character flaw, there is absolutely no justification for triple-digit interest rate installment loans. The unfortunate reality is that if 40% of Americans cannot afford a $400 emergency, then there are larger structural issues at play. People are not being paid enough for their work to live, let alone save. In times of struggle, the option shouldn't be a debt trap interest rate or nothing at all. This is particularly frustrating when states like my own, the Commonwealth of Massachusetts, go to great lengths to protect consumers from predatory lenders. Now, Massachusetts maintains criminal usury laws capping small loans at 23% interest while making it a crime to assist in providing a predatory loan implicating the lender and the bank. Ms. Johnson, how does this compare to protections in other states you have looked at?
So in response, I want to say that, yes, this isn't something new. The Pennsylvania Attorney General sued Think Finance, who had rent-a-bank partnership with First Bank of Delaware, and rent-a-tribe partnerships, in other words, partnering with Native American tribes in order to charge triple-digit interest rates. The lawsuit is going forward against Think Finance as a criminal enterprise with this partnership with the Native American tribe. So that's not something foreign. We have criminal usury statutes. In response to your question, we have some states suing civilly, we have some states suing criminally, but either way it goes, consumers need to be protected through these statutes to protect consumers from triple-digit interest rates.
Absolutely, and I still hear from folks in my district, Massachusetts 7th, and across the state about the continued availability and marketing of these predatory loans. There's also a question of what happens when the debt from these loans is sold. So, Ms. Saunders, how might a debt collector's pursuit of the purchase loan differ from that of a lender illegally operating in the state?
Well, debt buyers that buy charged-off debt are obviously going after people who are struggling the most and who often have been the target of predatory lending. And we've heard a lot of talk about the Madden case. Well, debt buyers are buying charged-off credit card debt for pennies on the dollar. They do not need to charge outrageous interest rates on top of that. And certainly, the Madden court was correct that it doesn't hurt banks not to let debt buyers continue to pile on to people who have been the target of predatory lending.
I think we eliminated debtors' prisons in something like 1833. But last December, ProPublica published their report entitled The New Debtors' Prisons, highlighting University of Utah law professor Christopher Peterson's work on the skyrocketing abuse of the state's small claims courts. I ask for unanimous consent to submit this article for the record, Mr. Chair.
Without objection.
Mr. Peterson's research is just one more case study into our continued criminalization of poverty and weaponization of the legal system against those who are already living on the margins. Ms. Saunders, do you believe that what we are seeing in Utah can spill over into states with stronger consumer protections?
Yes, unfortunately, we are seeing that Utah is the center of a lot of this predatory rent-a-bank lending. We've got FinWise Bank there and others that are enabling debts of thousands of dollars, tens of thousands of dollars over years, at 160% APR or higher. In one loan, there is a $4,500 loan that will cost $13,000 to repay. Okay, APRs matter. And if the lack of oversight and rate caps that Utah can spread across the country, then every state, including your own, will be the subject of predatory lending.
Well, back in 2017, Massachusetts Attorney General Maura Healey settled with the state's then largest debt collector for $1 million for egregious abuse of the state's small claims courts to collect from folks whose incomes were exempt. Ms. Saunders, what does it mean to have exempt income, and what are the unique risks of these aggressive collection practices to vulnerable communities?
Exempt income is income that you need for basic necessities, food, medicine, rent, and income that, like Social Security, other forms of pension, public benefits, and certain amounts of wages are exempt from collectors because we don't believe that people should have to starve because they are in debt.
That's right. Seems that this is less access to credit or really just access to debt.
The gentlelady's time has expired.
Thank you.
The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And
Interest rates are the price of obtaining credit. I'm a small business owner, Main Street, America. I've been in business 50 years and never had one day in my business life that I've been out of debt. In any line of business, price is determined by calculating many different factors. A business must cover the cost of hiring employees, keeping inventory, and paying taxes, just to name a few. Tom Miller of Mississippi State University stated, although 36% interest rate might sound high and profitable, personal installment loans are profitable at that rate only if the loan exceeds a certain size threshold. If we set a national rate cap at 36%, many of those innovative products that are filling a need for many people in our economy would no longer be profitable and cease to exist. Rather than increase government intervention with a national rate cap, we should allow capitalism and the free market to determine the price of obtaining credit. It's called competition. So before I continue with my questions, Mr. Knight, to you, are you a proponent of capitalism or are you a socialist?
I'm a proponent of capitalism.
Thank you very much. That's a great answer. We're doing good this year. This issue is about personal and financial freedom. If we in Congress set an arbitrary rate cap on what we think is too high an APR, we are limiting customer choice, limiting choice, and saying the government knows your financial situation better than you do. Unfortunately, some of my colleagues seem to believe that if we legislate high APR loans out of the marketplace, the demand for these products will simply go away. However, statistics show that millions of Americans lack the ability to pay for a $400 emergency expense. We should be spending our time on legislation that allows people to save more of their hard-earned money and build personal wealth rather than limiting the options available to them when they're most in need of assistance. So, Mr. Knight, can you elaborate on what population would be most hurt by enacting a national interest cap and what would happen to their availability of credit?
Yes, so in terms of access to credit, the population that would be most likely to suffer would be the more marginal borrowers. So that would be you're relatively less affluent, you're relatively young, underrepresented groups would be likely see a reduction in access to credit.
So a Bloomberg analysis showed that 5 years ago, 22% of Wells Fargo consumer loans were made to customers with credit scores below 680. Today, this number has shrunk to 11%. Traditional financial institutions are having to avoid riskier lending after greater pressure from regulators following the financial crisis, more government involvement. Unfortunately, these changes have made obtaining credit much harder for a person of that population. So, Mr. Knight, can you explain how greater bank partnerships can help solve this issue and the benefit to consumers that it would create?
Yeah, so there's a benefit on sort of two ways, potentially. One is better access assessment underwriting on the front end. And two is better balance sheet management and servicing on the back end. So a bank is able to leverage a partnership to access customers, underwrite them, service them, move the credit off their balance sheet into either a loan sale or a securitization, which is very similar to what we do with any number of other things like credit cards, car loans, et cetera, and then have that loan serviced. And this allows particularly smaller banks to access these markets, which allows for greater competition in the credit markets.
And most people deal with smaller banks. So, Mr. Knight, in your testimony, you talk about innovation and the benefits of bank partnerships with fintech companies. There is a misconception that these partnerships operate outside the bounds of any laws. So could you talk briefly a little bit about some of the third-party guidance that currently exists and how they help protect consumers?
Sure. Both the OCC and the FDIC have strong third-party guidance that both places a strong burden on the bank to manage its partner and the conduct of its partner, and holds the bank accountable for the actions of its partner as if the bank did it themselves. Also, under the Bank Service Company Act, to the extent that the partner is providing services for a bank, be it marketing, underwriting, or servicing or something like that, that partner is also subject to examination by the bank regulator. And if you talk to some of these firms, you'll see that they have bank regulators come in and visit them.
Well, I yield my time back. Thank you for being a capitalist. Thank you.
Gentleman yields back. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and I live half a block from Main Street in the Chicago neighborhood, and I've seen how predatory payday loans and sky-high interest rates are trapping too many consumers into debt traps. Consumers might take out a small dollar loan to meet a short-term need, and only to find that they can't keep up with the triple-digit interest rate on that loan. Soon, they're forced to take out another loan to meet the need, stacking debt on top of debt and trapping them in a vicious cycle. Ms. Saunders, can you tell us very briefly 2 instances of what happens when people get caught up in a debt trap, and what are the hardships and health consequences that consumers face?
Sure. When they get into a debt trap, they have trouble meeting other expenses, especially when they have very aggressive payday lenders or debt collectors after them. They may have trouble buying medicine or buying food or paying for their rent. In addition, these predatory lenders often require access to their bank accounts, and they take out money before they've paid for expenses, and they're going to incur overdraft fees and NSF fees.
Thank you. One major reason why I think it's so important for this committee to pass my bill, the Veterans and Consumer Fair Credit Act, is that it protects, the protections in the Military Lending Act have been shown to work. Veterans and military groups support my bill because they're familiar with the research showing that the Military Lending Act protects active duty service members from predatory loans and also pushes them toward healthier forms of credit. Assemblywoman Limón and Ms. Aponte-Diaz, what alternatives to payday loans exist out there that comply with the 36% rate cap, but make sure that people get the credit that they need without falling into a debt trap, and how have consumers fared in states with strong interest rate caps in place?
Thank you. And I want to point out that California has the California Pilot Program for Affordable Small Dollar Credit. And we've had that in place for a number of years, and that caps loans under $2,500 under to 36%. So that exists. It's a market that's been increasing over the last few years. And what we've also seen is that businesses are looking for regulatory stability to keep investing in this space.
And I'll just add, so I'm from a state, Maryland, who has never had payday loans or high-cost installment loans, and there are multiple other access to credit. There's credit cards. There's also credit unions, and to your point, minority deposit institutions or credit unions are not charging more than 36%. There is also just the targeting, the marketing done by these high-cost lenders is why it's concentrated in communities of color. It's on your phone, it's on our radio stations, it's everywhere. So this is sort of what our community thinks, this is what's available, but there's a lot more. There's emergency programs for utility companies, there's nonprofits, churches, and a lot of other things, but we are bombarded with the marketing from these high-cost lenders.
Thank you. A little bit of history on this issue for a moment. In 1978, Robert Bork, well-known jurist in our country, argued and won a Supreme Court case that allowed banks to export high interest rates. Here's how Benjamin Applebaum described what happened next in his book, The Economist's Hour. Quote, Citicorp's vice chairman compiled a list of 5 states that had lenient laws or might be willing to write new laws. One of the 5 names on the list was South Dakota, which was already moving to get rid of its interest rate caps. The bill sailed through the legislature and was signed into law. But that wasn't enough. Under federal law, banks needed an invitation to enter a new state. Citicorp executives flew to South Dakota and promised to bring 400 jobs. You may have heard that earlier. The company gave the text of the desired invitation to South Dakota's Governor, Bill Janklow. The necessary legislation was introduced on the last day of the legislative session in 1980, passed by both houses on the same day and signed into law by Janklow before the sun went down. He also declared that the need for jobs was an emergency, so the law took effect immediately. 400 jobs saved the state of South Dakota. Ever since then, South Dakota has exported high interest rates to consumers all over the country. So that's why we're advancing this bill. We need to learn from history and not repeat those mistakes.
The gentleman's
Thank you,
time
Mr.
has
Chairman.
expired. The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I do want to thank the witnesses for appearing this morning. Mr. Knight, if I could, I'd like to plow over some ground that I know that we've talked about this morning and make a couple of observations. One, again, we've talked about this, that I think every member of Congress has constituents that lack the ability to pay a $400 emergency expense. They're my constituents, and everybody else represents these hardworking people as well who literally do work paycheck to paycheck. The second observation is we've talked about, we have a number of people in our communities, for all the reasons we've discussed, who are becoming unbanked or debanked. So again, if we look at capping interest rates at, say, 36%, a couple of questions. One is, what happens to access to credit for those who are unbanked or underbanked in my district or any other district, maybe whose credit score is around 600, give or take? If you could address that question first.
So we would expect to see a rationing effect of credit. So some loans would not get made because they could not be made profitably. We would also expect to see a distortion in the model of credit because APR is just one factor in a loan. And so if you have to squeeze the balloon, you would see either larger loans being made or longer timelines being made or some combination thereof. There's also evidence that you'd see a shift from independent loans to loans secured by something or loans made by, say, a seller. And there's a CFPB working paper that shows that in the presence of a binding usury cap, you don't see subprime independent auto loans. You see the dealer of the subprime car dealer be the only lender because they can raise the cost of the car. So it's a smaller interest rate, but applied to a bigger principal, which becomes a problem if you want to prepay the loan or default on the loan, and you end up buying less car for more money.
Can I just add that payday lending actually leads to being unbanked?
Thank you. Mr. Knight, if we could look from a historical perspective and maybe look 5, 6, 7 years ago at Chile, they instituted a cap rate of 36% on small loans, unsecured loans. Are you familiar with what happened in that country?
There was, as expected, a rationing of credit. There was a reduction in access, and the reduction in access fell disproportionately on the relatively poor and the relatively young.
And what further result occurred when they capped the rate at 36%?
So, well, my recollection is that, yeah, that there was that rationing of credit effect, that you saw fewer loans being made, and people had to then compensate in some other way. And there's other evidence, another scholarship that indicates that in the presence of a credit rationing, particularly something like a subprime credit rationing, people move to other alternative forms of credit. They don't go up to like a prime credit card. They go to another alternative form or something like overdraft.
Thank you. As far as usury laws are concerned, they essentially set a cap on the price that a lender can recoup for making a loan, unless, of course, the lender gets into fees and other charges. Can you talk about how those laws affect the incentives to lend in a given market?
Yes. So, as I mentioned, a usury cap is going to disincentivize loans made to relatively risky borrowers because they cannot be made profitably over the portfolio of loans. They're also going to incentivize either shifting to more fee income rather than interest rate income if the law allows for that, or shifting the structure of the loan to be generally higher principal and longer term so that while the APR is lower, it is actually acting on a higher principal for a longer period of time. A useful exercise is if you compare a 30-year mortgage at 4% APR versus a payday loan at 2 weeks at 500% APR, taken to their natural term as a principal, or interest as a percentage of principal, it's actually higher with the mortgage because even though it's a lower APR, it's a longer loan.
Thank you. My time is expiring. I yield back. Thank you.
Gentleman yields back. I now recognize the gentleman from Texas, Mr. Green, who's also the chair for the Subcommittee on Oversight and Investigation. Recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing as well. Mr. Knight, persons who are caught in this debt trap, who received loans that they could not afford, what do you propose we do for the countless number of people who are caught in these debt traps? Do we just write them off as persons who should not have engaged in this process? They should have been better educated. Maybe they should have made more money. Perhaps they shouldn't have been poor. But what do? We have people who are being harmed when we know that things shouldn't be occurring as they are. The Supreme Court has ruled since the 19th century that you cannot engage in a scheme to create loans that are usurious. So what do we do?
Thank you very much for your question, sir. And it's a very valid concern about the plight of people who are trapped in suboptimal situations. And I don't mean to make light of it. It's a very real concern. And I would say that I think we're looking at sort of a two-prong issue. One is the underlying macroeconomic situation.
Well, I understand that, but let's not use my time explaining the micro or the macro, either of them, economics. Tell me, what do we do with the people, for the people?
So I would say that our best bet is to provide people with better options, because the risk we run is if you can legislate away the supply of credit, you cannot legislate away the demand for credit. And so the better option is to provide better options for credit for people who are poorly served. I don't think anyone thinks that a payday loan is the pinnacle of credit, and I hope we move to something that is better and more broadly available.
We're talking about people now who are entrapped into this cycle of borrowing. We know that it is unlawful to develop a scheme such that a bank and a non-bank entity can enter into it for the purpose of having an interest rate that they could not ordinarily have in a given state. That's unlawful. So what do we do? What do we do for the people who are caught in this trap?
Can I add that this is a bigger problem than just access to loans? This is low wages historically in our country. When the gentleman speaks about Chile, if we're following what's recently going on in Chile, I mean, there's a huge inequality issue in Chile, and they are still struggling because of wage issues. So we need to not try to solve this problem by giving people loans of 150% APR. Even at 36%, a $10,000 loan costs $10,000. So APRs do matter, and this is not the solution that we should be talking about is like, oh, we should let the free market charge whatever, 100%. 36% is generous. It's a very generous number to say that you can charge someone that amount.
Thank you. Mr. Knight, back to you. What do we do when we have persons who are in this position? We have at least one recommendation, but the other side doesn't offer any alternative. They don't come with a plan to help extricate people from the enigmatic circumstance. Their plan is leave things as they are. This is the way things are, and they should continue. I'm asking you for a plan. What do we do? There's a plan on the table. What do we do? Ms. Johnson, are you attempting to weigh in?
I was not, but I was just thinking in my head that we need to pass, if we don't want an interest rate cap, Then we need to say banks in partnership with non-banks should not be able to do multiple rollovers, should not be able to extend the maturity date multiple times, should not be able to electronically debit people's credit cards or bank accounts over and over again, should not engage in illegal garnishments in order to collect on the debts. In other words, we need to, if we're not going to have an interest
With
rate.
my time that I have left, pardon me for interrupting.
Thank you.
I'm going to challenge my colleagues on the other side to give us a solution as opposed to an objection. I yield back.
Gentleman's time has expired. I now recognize the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Chairman, and thanks to Chairman Waters, Chairwoman Waters, and Ranking Member McHenry for organizing this hearing today. Mr. Knight, I think has already been discussed here today, the valid when made issue is often confused or used interchangeably with the true lender issue. When Chairman McWilliams testified in a Financial Services Committee hearing here in December, she tried to clarify that the FDIC's proposed rule did not touch the true lender doctrine. Do you agree with Chairman McWilliams' assertion that the true lender question is outside the scope of this rulemaking?
I do.
Thank you. When done properly, bank partnerships with non-bank lenders are good for consumers, good for competition, and good for innovation. These partnerships and a healthy secondary market for loans also help extend credit to consumers who might not otherwise be able to access it. This includes many of my own constituents in the 6th District of Tennessee. Mr. Knight, in your comments letter supporting the OCC's rulemaking, you noted that these bank partnerships are a critical aspect of the business of banking. You go on to also say that having these loans remain valid is critical to the modern economy. Why is the ability to sell a loan important for banks?
It's important for banks because it's an important function of both safety and soundness concerns, the ability to shift risk off their platform in a meaningful way, and a potential source of revenue, particularly for smaller banks who don't necessarily have the deposit base to hold a whole bunch of banks or a whole bunch of loans on their balance sheet given the regulatory requirements that they face. And so if we want particularly smaller community and other banks to be more competitive going forward, they need options to manage that, and these bank partnerships provide such an option when done well.
Earlier, Ms. Talib cut you off when asking about the illegality of these arrangements. Would you like to take a moment and complete your response there?
Sure. The point I was going to make is, it's not that, I think we need to distinguish between a rent-a-bank scheme and a bank partnership because they are two separate things. A rent-a-bank scheme is where the bank is a passive party that basically just allows whoever, the non-bank lender, to impersonate it and just sign off on everything that's done. What these bank partnerships are, the bank actually exercises ownership, discretion, and control. They are ultimately responsible and they ultimately have the final say, and they have a relationship with these partners akin to that of a vendor.
I think you made an important point in your comment letter that I would like to highlight here today, and you've just reiterated a few moments ago, which is that diminishing access to credit does not diminish the need for credit. I see this in my district, and I want to make reference to Mr. Lukemeier's comments earlier about what happens when we restrict the ability of individuals to get those small dollar loans that they may need on terms that they want, which is to borrow for a very short period of time. And I see this in my community all the time, and just want to stress the importance that we may think when we impose statutes that limit those types of transactions that they somehow go away. But I can assure the listeners and our experts testifying and my colleagues that they don't go away, that people find ways to get the credit they need, whether that be by extending terms in some way or whether it be by seeking that credit through non-traditional sources. And that's what I often see in my community where I guess so-called bootleg lenders are available, loan sharks, if you will, that unfortunately we force borrowers to seek out when we restrict their ability to access the credit that they want and that they need through traditional terms. I want to conclude by just stressing that it's important to note that the 115th Congress, in the 115th Congress, this committee passed legislation on a bipartisan basis that would have codified the valid when made doctrine. And when that legislation, H.R. 3299, came to the House floor, it again passed with bipartisan support. And so I think we would be well advised to keep those, to keep that bipartisan mindset in mind. And with that, I yield back.
The gentleman yields back. I now recognize the gentleman from Florida, Mr. Lawson, for 5 minutes.
Thank you, Mr. Chairman. I would like to welcome you all to the committee. And I will start off with you, Ms. Saunders. Can you please explain the true lending doctrine?
Sure. The true lender doctrine is just a variant of centuries-old rules that usury laws should not be evaded. The Supreme Court, as early as, I think, 1838 and probably earlier than that, has said that we're going to look beyond the form of a transaction because predatory lenders are very creative and we're going to prevent evasions. True lender is one form of evasion where a state-regulated lender hides behind a bank, but the payday lender or the other state-regulated lender is the true lender.
Okay, Mr. Knight, did you want to comment on that?
Yeah, I just to elaborate that the doctrine, which is not universally applied. Some courts apply it and some courts adopt a more contractual analysis of whoever the lender is on the contract is deemed to be the lender. As I mentioned earlier, it seems that the emerging trend is to look at who has the predominant economic interest in the loan. And so if a bank already has a purchaser lined up for the loan, that would indicate that the bank, that weighs against the bank being the true lender in the court's mind versus a loan that the bank intends to hold for a while. So for example, the Madden decision doesn't deal with true lender because the bank held the loan until it defaulted.
Professor Johnson, how do you feel about that?
The true lender doctrine, first of all, I agree with my fellow witness. It's a long-standing doctrine, right? And what we're talking about with these new transactions, at the end of the day, the payday lender or the non-bank lender performs all the servicing functions, all the debt collection functions. The bank itself might have an interest that effectively amounts to 10%, maybe 20% of the receivables. To me, that is not a situation where the bank is in control. He's describing a scenario where the loans are on the books of the bank. In the cases that we're talking about, including pending cases, and I would direct you guys to read my statement where I talk about Cabbage, fintech lender, who has partnered with Celtic Bank in Utah. At the end of the day, the non-bank Cabbage is basically doing all of the lending functions, right? All of the servicing related functions. And so Cabbage should be the true lender. So simply saying the bank is involved somehow in a way with a partnership does not do away with the fact that the predominant economic interest is still with these non-banks. And so therefore, if we're not going to cap the interest rates, we should do something else about what the non-banks can do in terms of servicing these debts and collecting on these debts.
Professor Johnson, in capping the interest rates, will that provide more opportunities for individuals, especially in minority communities, where they have to go oftentimes to a payday lenders in order to make it to the next paycheck?
So capping interest rates, it may drive down payday lenders in the community, but that doesn't mean that there are not other lending alternatives. As my fellow witness has identified, you've got millions of dollars being spent in advertising by the for-profit non-bank lenders, whereas credit unions and some of these other entities They don't have all of this advertising, and so the person in your community may not realize they can just simply go to a credit union and get the same type of loan, except at a better interest rate, on better terms, allowing them to pay it back over a longer period of time, also benefiting from budgeting and other services provided by the local bank or credit union, community bank or credit union.
Elena, would you like to kind of comment on that?
Thank you. And I would say that there are states are doing different things. There's multiple options. California has a pilot program. But I think that another piece that's really important to highlight is that as we have this conversation about rent-a-banks, they are really going around state laws. In July of 2019, before the bill had passed in California, before it had been signed by the governor, there was a conversation with these companies about how they were going to evade the law. And that, I think, is what we're trying to get at, how we ensure that these companies don't evade the law by finding a partner outside of the state to do business as usual and offer products that are not good for consumers.
The gentleman's time has expired.
Thank you.
I now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Mr. Chairman, and thank the panel for being here. Very important discussion we're having here, because what we need to be focused on is how do we make finance available, especially to the most vulnerable communities. And I think what my friends on the other side of the aisle are doing is going to be harmful to those very communities. I'm talking rural and minority communities, because those are the ones that have a problem getting access to capital. And I appreciate the comment was just made about a conversation of evading the law. I know of the conversation, but I don't know that anything has transpired with that. So, Mr. Knight, I'd like to ask you a series of real quick questions, because I think what's happened is we've demonized something that has been standard operating practices in the financial services market for a couple of centuries now. Since we've been here today, some have tried to portray the OCC and FDIC rulemaking as when made as a new regulatory giveaway to banks. My understanding is the Madden decision deviated from nearly 2 centuries of precedent in banking law. Is that true?
I believe so.
Do these proposed rule changes do these proposed rules change the agency's underlying policy, or do they simply codify the agency's longstanding position?
They codify the longstanding position.
2 centuries worth of longstanding position.
Yes.
That has worked very well.
Yes.
I mean, when I make a loan, I really don't care what happens on the backside of it, as long as my interest rate is the same all the way through. I'm okay if it goes down, but I need to know that interest rate's going to stay the same, and the person loaning the money to me, they need to be profitable so they can make more money. I think that's an important position to have. Another question, non-bank lenders are not permitted to export interest rates unless they are partnering with a bank or credit union that originates the loan. Is that true?
I would clarify that the bank is the one, or credit union is the one exporting the interest rate, because they are the lender.
So there is a bank, a regulated bank on the back side of this, correct?
Correct.
In order to benefit from banks' interest rate exportation authority, non-bank fintech lenders must submit to regulation as third-party service providers by the banking regulators, and the bank is accountable for the actions of its fintech partners. Is that correct?
In the bank partnerships we're talking about, that's what the law says.
And that's what we're worried about,
Yes.
is these fintech partnerships. Do federal banking regulators check to make sure these loans are made lawfully during the exam process?
Yes.
They are. Is there widespread abuse of these bank partnerships by payday lenders?
Not to my knowledge.
Do you know of any that are exporting it?
I do not know of any.
Okay, I haven't heard of any either. Cabbage was brought up. I had a small business. We had lines of credit. We were going through a traditional bank, credit unions for small business lending. After Dodd-Frank, my business no longer qualified for those loans. Had there been a Cabbage available, I would have been able to save a lot of employees that I had to lay off because I couldn't have access to capital. So I think we need to be very careful in demonizing businesses that are actually providing funding to markets that traditional banks and credit unions can't.
Can I add something?
I'm not quite done yet. Why has the availability of credit decreased and personal bankruptcies increased in the 3 states
since the Second Circuit made the Madden decision?
Well, based on a recent study, the authors link it to the lack of access to marketplace lending and the inability of borrowers who would otherwise be able to either refinance an existing loan or deal with some exigent circumstances like a medical bill, the inability to access credit.
And low dollar loans is an issue. And this is and I apologize, but I've got a short amount of time, and I always run out of time. Regarding another issue, which we're talking about a national interest rate cap, here's a concern I have. It's all, smaller dollar loans is a big problem. 40% of Americans can't afford a $2,500 emergency that they have. They need access to credit. The problem we have is a George Washington University study indicated that the break-even APR of a $2,600 loan is 36%. That's the break-even APR, which means you're going to borrow below that, you need to have some higher interest rates, right? So a 36% national interest rate cap would effectively eliminate loans under this amount. A study by the Federal Reserve Bank of New York indicates that up to 60 million Americans do not qualify for traditional bank loans.
The gentleman's time has expired.
Mr. Chairman, may I submit the study for the record?
Without objection.
Thank you. I yield back.
The gentleman from Washington, Mr. Heck, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank all the members of the panel as well for the presence today, more importantly for your advocacy on behalf of people who need a voice. Frankly, the older I get, the more I've come to the conclusion if we're not here to give voice to people who don't have one, I'm not quite sure why we are here. I appreciate much of the conversation thus far. I appreciate what I think is an important element of this, which is the access to credit issue and the implications of this proposed policy and the off-cited data point, which Congresswoman Presley cited, that 40% of American households don't have $400 to meet an emergent need. And that's a balancing consideration in this debate going forward. So too do I think there should be a balancing consideration of what is it that states have actually done, albeit too few of them, and the graph happens to be up right now as I speak. I'm from Washington State, and we're pretty proud of our efforts at consumer protection. Years ago, we enacted a payday lending limitation statute, which was very hard wrought. We're talking tooth and nail, knockdown, drag out. And by just about every measurable account, it's working. Now, I don't pretend to be the total expert, but here's what I do know. I know the reports are good from consumer organizations and the regulator. I know that the number of payday lending locations has declined by 90%. Payday lending dollar volume down 83%. And perhaps best of all, the number of complaints filed with our regulator has decreased from hundreds per year to 40. It seems to be working. And so that begs a question for me in the broader context of this. I think, Ms. Saunders, I'd like to ask you, is there a compelling argument for state preemption or federal preemption of state statute, state policy, when there is arguably a comparable consumer protection regime?
No, there's not. I mean, as I said in my opening statement, American is apple pie for states to have interest rate caps to protect their residents. All the states have them. Of course, it goes back to the Bible, and most states have them today. Unfortunately, although Washington State has good laws, you've cut off, and it's a modest law. No more than 8 rollovers, and yet the payday lenders couldn't live on that abusive model. But in Washington State, although you only allow 29% on a $2,000 loan, there's a rent-a-bank lender, Op Loans, that is using FinWise Bank in Utah and is making 160% APR loans up to $4,000 in Washington State. And there is nothing under the National Bank Act that allows non-bank lenders to obliterate the centuries-old usury caps that states like Washington have to protect your citizens.
So your point of view, and I'm asking in all sincerity, is a Washington State law does not protect its consumers to a sufficient degree, notwithstanding the data I shared and the reports I get.
The Washington state laws are quite good, but there are a couple of lenders that are starting to evade them using this rent-a-bank model. And if we don't put a lid on it right now, you're going to see a lot more problems.
Isn't there a way to solve that without an overall rate cap?
Well, I think an overall rate cap would cut off the worst of the high-cost rent-a-bank lenders, but we also can simply stop banks from exporting high-rate loans into states like Washington that don't allow it.
So remember my premise here, which is that we're here to provide and extend protection to people who are vulnerable. I think it is worth keeping in mind that federal preemption is a two-edged sword. And that what one hand giveth, is that a word? The other hand can taketh away. And I always feel compelled to remind people that if we want to go down the road of federal preemption, understand there's another side of that coin. That if federal preemption seeks to, if the policymakers seek to, can remove those consumer protections. I've had this argument or debate or good-hearted back and forth with my colleagues on this committee for quite some time as it relates to insurance regulation. I live in a state where the insurance commissioner is doing a great job, and I don't want somebody to come in and set a lower standard than he has set. And the same danger presents itself when it comes to this area. But I will take into account and further plumb your feedback on
The
our
gentleman's
law.
time has expired.
And I guess I'm going to stop talking.
The gentleman from Ohio, Mr. Davison, is now recognized for 5 minutes.
Thank you, Chairman. Thank you for our witnesses. Appreciate your efforts to make sure we get this right. Mr. Knight, I think you said it perhaps best, that Congress could enact legislation that would restrict the supply of lending, but we wouldn't be able to dramatically affect the demand. And so what happens when we have big disconnects between supply and demand? Normally, black markets form, right? So we have large black markets all around the United States. It's a significant part of U.S. GDP, and a lot of that's attributable to broken market systems. And some of those are resultant from legislation. So could you highlight how, a rate cap would do just that, limit supply without checking demand?
Yeah, absolutely. I mean, ironically, one of the great progressive reforms in this very area was the Uniform Small Loan Law of 1916 by the Russell Sage Foundation, and their recognition was that usury rates were too low to attract legitimate lenders and that they needed to actually allow people to make profitable loans. And when they made those reforms, they were opposed by the religious leaders and all that stuff who wanted the much lower rates, but also loan sharks who wanted to continue to operate illegally and not face legitimate competition. And so the risk we run if we set an interest rate that is binding and limits and constricts credit is that either we cut people out of the legal system and they have to go seek some inferior alternative, including loan sharks, or we have to distort credit products so that they're inferior to what they would have gotten otherwise, and therefore are a worse fit than they could have had we left the market.
Yeah, thanks for that basic explanation. And my colleague, Mr. Green, was highlighting what is the alternative. Well, the alternative is to make the economy grow, to create more jobs than there are to people to fill them, to see wages rising instead of stagnant, to have wages at the bottom portion of the economy growing faster than wages at the top of the economy, to get past the broken status quo of stagnant growth and on to the economy that we're enjoying today. And we did that largely through deregulation, tax reform that incentivized investment in the United States and growth. We still have a long ways to go, but we're making progress. And Ms. Saunders, as you're aware, this past year, Ohio passed a law that regulated payday lenders or lenders in question related to this hearing. Pew, a consumer advocacy group very similar to your organization, NCLC, has said that the Ohio legislature got payday loan reform right. The structure of the loan has an interest rate component plus fees. Here's an example of what Ohio's law allows. If you lend $300 for 4 months under current Ohio law, the APR could be as high as 161%, depending on what day of the month the loan is originated. It doesn't appear that Pew thinks a 36% rate cap is the right reform. They also support bank lenders that charge rates at least double the 36% rate. Why is there a disconnect between Pew and NCLC?
You know, I think Ohio is following on the path of Colorado. Ohio voters voted to cap rates at 28% overwhelmingly back in 2008, but the payday lenders decided to call themselves mortgage lenders in order to be able to charge a fee allowed for mortgages, and they got around it. And the legislature, where there's a lot of big payday loan money, unfortunately blessed that. Eventually, after a lot of hard work, going up against big money from predatory lenders, the Ohio legislature came up with something that allows high-rate loans like Colorado did, but eventually Colorado voters voted for 36% rate cap.
And fees. And then what will happen is the same challenge of black markets. Professor Johnson, I like your framework, and as another Ohio person, thanks for coming to share your expertise in the field. I like kind of the rubric that you laid out, but I don't necessarily understand the mechanisms of how it worked. For example, debt entrapment. Could you explain how someone is forced to take this loan?
Okay, so by debt entrapment, I don't mean that somebody is being forced to take the loan. By that, I mean that you have set up a scenario where a person is signing up for a loan, not really understanding the consequences of that loan. And so, for example, if we talk about the payday loan rule that was to take effect this past year, it would have required you to do the ability to pay. Right, so underwriting, ability to pay, that should be something that should happen now.
So sound underwriting practices would help make a difference. And, frankly, I'd like to go into a lot of areas where we totally disregard sound underwriting practices and we socialize the risk. We distribute the risk over everyone, including people that can qualify for lower rates. So thanks for the hearing. And
Gentleman's time has expired. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman, and thank you for the witnesses being here. I apologize I wasn't here earlier. I also sit on Foreign Affairs, and we had the unique challenges women face in global health, and I wanted to be there for that presentation. But now that I am here, I do want to ask this. APR does matter, and if you don't think it matters, we don't take those 300% loans. I always tell my two daughters, I say, don't listen to what people say, watch what they do. You go to the beach and they say, oh, the water's warm. I say, well, why aren't you in? Hell no, I'm not getting in that cold water. We don't take those loans because we think they're predatory. That's why we don't take them. But I did want to talk about the states' rights versus federal preemption. It is interesting. I've been around long enough to listen to Republicans always talk about state rights, the strong state rights, except when they don't like them. And then they're against the state rights and the federal government should be involved. California, Assemblymember Limón, you passed the law. It seems to be working. Obviously, it's early on. Could you comment the process you went through and the state went through to do that?
So this was a very extensive process. It's been tried for well over 2 decades, but we really put an incredible coalition together, faith-based groups, Urban League, you had veterans groups, you had responsible lenders, all to try to come up with a solution to one product, which was the fastest growing product in the market that was most harm to the consumer. And we passed this law, and it was signed, and now what you see is that there are companies evading it. And I actually want to use Mr. Knight's description, if I may. He talked about the rent-a-bank scheme being an impersonation of the true lender. And based on that description, I argue that the rent-a-bank schemes ongoing in California will clearly show that the non-bank lender is the lender. I want to give an example of what is happening. When you see a title lender like LoanMart advertising their loans on a website between 60 to 220%, and in the fine print at the bottom of this website, you see that it says that the loan is made by a bank in Utah. That is what we are talking about. They are evading state law. The state law is very clear that it is 36% plus the federal rate, and now they are using a bank outside of the state to evade an existing law.
Ms. Aponte-Diaz, you stated at one point that the debanked, that actually they get hurt taking these predatory loans because, in fact, oftentimes they get unbanked. Could you explain that a little bit?
Yeah, I've spent the last 7 years in California talking to payday borrowers, to folks who've gotten the installment loans, and there's not one of those former payday borrowers that said, I would go back and do this again, or I would go to the black market. They, once they get out of that debt trap, they are done with it and look for better access to credit. So, to your can you repeat your question one more time?
Yeah, you said that what happens, you snuck it in there quickly.
Oh, the unbanked. Yes, I'm so sorry. So payday lending and increasingly installment lending, you have to give your bank account information so that it can be deducted directly from your bank account. So what we see often is, maybe they don't have enough, the borrower doesn't have enough money to pay their rent or groceries or utilities, and the payday lenders come and still take that money out. And so if there is no money in there, then you've got your overdraft fees over and over, and then those lead to bank closures. So I was arguing against, we're not trying to help the unbanked.
You had to sneak it in there. I just wanted to hear your explanation. I appreciate it. Thank you very much.
You.
I do want to ask one last question. I have about a minute left. The issue that you can't loan to anyone $2,600 or less at 36% because it's just not doable. Could any of Professor, Ms. Saunders, could you comment on that? Whoever would like to. Go ahead, Ms. Saunders.
Well, I'll just say I just don't think that's true. I think, Self-Help Federal Credit Union, an affiliate of Center for Responsible Lending, certainly does it. In South Dakota and Montana, when the voters capped rates at 36%, we actually saw an increase in credit union small dollar loans.
Well, that's what I believed, but I heard it almost as if it was coming from Moses here, that this was in case of the law. But I also have to thank you, say most of it does go back to the Bible. As a former Jesuit, I appreciate that. And you do have usurious laws and in the Bible to we don't violate. Mr. Knight, would you like to, you got 20 seconds left. Would you like to comment on any of that?
So I would just say that I think it's fantastic if credit unions can fill some of this gap, but there's a capacity question as to whether or not how much of the gap they can actually fill. And it's an open question.
I wanted to give the Republicans an opportunity because everybody seems to just talk to you and not to the others. I want to make sure you have equal access.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
Thank the chair. So, Mr. Knight, I appreciate you being here. So much of the discussion surrounding the Madden case, I think I've heard it mentioned earlier from my colleagues, it has to do with the valid when made doctrine, which says that a loan does not become valid when transferred to a third party. So the idea behind valid when made is that a loan is valid from the beginning. It can't suddenly change when transferred to another person or another company. And to my understanding, this has been part of the banking law in the U.S. for about 100 years. So far, so good?
So I think it's been part for longer than that. If I may, I want to note one thing just for completeness.
Please.
There is a counter-argument that says that the early cases largely dealt with note assignment, and so the fact that it was 2 subsequent loans is relevant. I disagree with that,
But those were the early cases.
Those were the early cases, but those cases, as we acknowledge, banking changes rapidly, and more recent cases have held that a subsequent transaction does not invalidate the loan. And I think if you look at sort of the notion behind it, there isn't a reason why a subsequent downstream transaction that does not change the borrower's obligations should relieve the borrower of their obligations.
So I want to continue. I've reclaimed my time. Thank you, Mr. Knight. So, however, the Madden versus Midland Second Circuit decision in 2015, it kind of branched away from this long-standing principle, and it ruled that loans could become invalid when sold from a bank to a non-bank. So as a result of this decision, credit markets have become volatile. Many borrowers have seen their access to credit diminish, as we've talked about today. And it's at a time when we should be doing everything we can to provide small businesses and consumers. I even heard my colleague from Georgia mention that his lack of capital access as a small business owner. But we should be providing better access to credit and financing alternatives. So it seems unwise to put caps on consumer loans. So, Mr. Knight, in your opinion, was the Madden decision wrongly decided?
I believe it was.
And in what ways has the Madden decision actually hurt low-income borrowers? So hurt low-income borrowers' access to credit?
Well, based upon the academic evidence I've seen, we've seen a constriction in credit and a resulting, there is evidence of a link to increase in bankruptcy as people who need to access credit to address either an emergent situation or an existing loan, right, where they need to be able to refinance an existing loan, are not able to do so. And one of the weird wrinkles of this is that you can be under a credit card debt at 30% and not be able to access a marketplace loan at 25% to refinance it, because in the latter case, the bank is planning to sell the loan. That strikes me as nonsensical.
So just striving for clarity here. We put these, we have this decision, this Madden decision. We cap these rates trying to help people, because I think on both sides we really want to help people here, absolutely. But it ends up hurting people? I mean, that's what I'm hearing from you.
It appears to be rationing credit, and that appears to be having a harmful result.
More bankruptcies.
That appears to be the evidence.
Great, thank you. I'm going to continue on. So I would like to make two observations and then tie them together into a question. The first is that it is incredibly troubling that millions of Americans lack the resources to pay for a $400 emergency expense. I think we all can agree with that. That's very troubling. But today, as we speak, hardworking Americans are living paycheck to paycheck. When times get tough, they may need to borrow money from somewhere. The second observation is the basic principle that our financial services economy is built on risk-based pricing. Many of the people I've described have credit scores just right above 600. And today they have access to credit, and lenders lend to them in accordance with state and federal laws designed to promote safe and responsible lending. So here's my question, Mr. Knight. If we cap the interest rates at 36%, what's going to happen to access for credit for the unbanked and the underbanked folks across our country? Will their need for credit just magically disappear? Or is it more likely they'll turn to unregulated credit if regulated creditors turn them down?
The need for credit will not disappear, and so to the extent a borrower who previously could access credit and is now priced or capped out of the market, they will either search for illegal or otherwise alternative credit or suffer the consequence that they were seeking to avoid with a loan.
Thank you. I believe I'm out of time. Thank you for your time.
Gentleman yields back. I now recognize the gentleman from Texas, Mr. Taylor, for 5 minutes.
Thank you, Mr. Chairman. Appreciate this opportunity for this hearing. I just wanted to quickly do a lightning round. So a bank profit margin is about 10%, right? So, and other businesses have higher profit margins, some have lower profit margins. What is an unacceptable profit margin in your mind for payday lenders? And I'll start with Mr. Knight. I'm just looking for a number, 8%, 10%, 100%. What's an unacceptable profit margin for a payday lender in your mind, Mr. Knight?
I don't have a numerical answer, I'm sorry.
Ms. Sanders?
I focus on the impact on the consumer, not on the profit.
Got it, okay. Professor?
No magic number, more concerned about the terms of the loan as well as the interest rate.
All right, Ms. Aponte-Diaz?
We've asked the payday lenders for a description, like they're telling us they need to pay for their storefronts, for their employees, for the risk, and we have asked over and over for details about how much, why they have to charge 100% to make ends meet, and we have not seen the documents on that. But what we have seen is that there's 40% default rates on these high-cost installment loans. And
Sorry to cut you off, but do you have a number?
No.
Okay. I'll come back to you in a second. Assemblywoman?
No numerical number. It is to do right by the consumer.
Okay. So just going back, so have you looked at, there are publicly traded payday lenders. Have you looked at their profit and loss statements?
No.
Why? I mean, if you've asked, you don't have to ask
Oh,
them.
no, but there.
You go look at their FEC filings, right? So you
Right.
got a K-1, you can go look at that. Have you looked, you haven't looked at that?
I have not personally, but.
Okay.
But
all right. Mr. Knight?
Yes, so there are a couple of studies that look at that, and payday lenders are not particularly profitable relative to other finance companies. In fact, they tend to be significantly less profitable than more traditional finance.
You want to put a number on that?
I don't have the exact, I believe, don't quote me on this, but I believe they're about a third as profitable.
I've seen numbers for the 8 to 12% range in terms of profitability.
Yeah.
So sometimes higher than banks, sometimes lower than banks. But I mean, I haven't seen anything that indicates. So what generally lowers prices is competition, right? I mean, so if you have lots of people competing to provide something, it drives the margins down to where it sort of comes to be a risk, when business terms, a risk-adjusted rate of return. So hey, that's an acceptable rate of return. And then in terms of, in terms of pricing, thinking about processing a payday loan, right? So you're going to process a payday loan, you would need to buy a credit report, right? You would need to have a human being standing at a teller to fill out the forms. You would, I mean, those are some of the prices that go into not just the interest rate on the money, but the actual processing of the form. Do you want to speak to that, Mr. Knight?
So my understanding, based upon the research I've seen, is that a lot of the expense about payday loans is overhead. It's location, because this is largely a convenience-driven business, and it's staff, because it's human-intensive and the hours are long. And so, yes, a lot of the cost is what we would consider to be overhead.
Right, and so if we put lots of regulatory burdens on lenders and make it really difficult to lend, then we're actually making there fewer competitors, and that in turn should drive up prices and make the margins higher. I mean, just it's harder. If it's harder to do, it gets more expensive as a general rule of thumb.
Well, excuse me, sir, just to add, what we have seen is $8 billion stripped in payday lending and car title loans in fees across the country, so $8 billion.
I don't know what that means. Okay, so Mr. Knight, just thinking about what banks do, so they typically hire consultants to do, so their IT work, right? So banks hire consultants to do their IT systems, their mobile banking applications for small regional banks. They've got to go hire someone to go do that for them. They hire companies to do loan processing, right? To actually create the document processing management system. They go to outside credit bureaus to go get their credit reports. They don't do that internally. And so, they interact with the federal government, with the SBA loan program. So it's very normal for all businesses, but banks in particular in this case, to use outside vendors to go provide services for them. What would be the benefit to a bank to use an outside vendor to help them underwrite smaller loans?
Well, to the extent that this vendor has a good model and good technology, and I should note that ultimately the bank has to own the model. And my understanding is, from talking to some of these companies, the bank does own the model. They don't just accept the model whole cloth. They push back, they work on it. It's a collaborative process. But to the extent that this new customer, this partner can bring new technology, new capabilities, it can benefit the bank.
All right, thank you. Mr. Chairman, I yield back.
Gentleman yields back. All time has expired. Without objection, a statement from the California Attorney General, Javier Becerra, and a statement from Hope Credit Union, both supporting the preservation of state laws that better protect consumers, are entered into the record. I'd like to thank our distinguished witnesses for their testimony today. Your testimony has been very important and very insightful to all of the members, I am sure. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is now adjourned.